thanks for coming, and sounds good. Okay, thanks, Greg. I guess you just said that sounds good. Good. Okay, here we go. Thank you for coming, and I asked to really lead this off because this is really all about getting your wits about you when you're trading. You know, as you get older, and I think it's, at least it's true for me, the value of time becomes something you can't deny. It's the most valuable thing you have, how you use your time. And I'm sure you've come across this in your life, in just about everything that you do. They say that somebody on their dying bed, most people say they spent too much time working and not enough time appreciating their life around them or their family. And I think that for we traders, it can be very intense as far as being successful in trading. The more disciplined you are, believe it or not, the easier things come because the emotions are put to the side. That's really why I've decided to have discipline and training traders on the discipline side of things my passion, because I think it really is the most important thing. You really only have two things. You have your trading plan and you have your discipline to run that trading plan. But today we're going to talk about managing your time. I hate to call it time management because it's more about time appropriation and how you go about sectioning your time, running your time as a trader, and giving your other life, your other than trading life, the respect that it deserves. So let's go into, and I'll give you a few tips along the way that I think may be important for you. The trading time system, as I call it, maximize your trading success by balancing your trading preparation, trading focus, and your free time. And all of them are of equal importance. Those who are type A's tend to spend all their time wanting to trade, and they do very little preparation, and their free time is spent without focus on other things other than trading. Their mind always goes to trading and what they want to do next, or how well the last trading session went. It's what you really want to do here in balancing your time is to compartmentalize your thinking as far as these areas are concerned: trading preparation, trading focus, and free time. Now this concept, I based it on an entrepreneurial time system created by Dan Sullivan of Strategic Coach. I've been trained by Dan. He's one of my mentors. He's been training me now for the last 5 years. He trained some of the top entrepreneurs in the country. Sitting on the left of my class is a guy named Dean Graziosi, who's doing hundreds of millions of dollars in flipping real estate. The guy on the right is Jeff Walker, who just came out with a book called Launch and is big on internet marketing. And here I am, a guy helping traders they're helping me do the best in getting my message out. So, and one of the things that he teaches us as an entrepreneur is to manage our time. And that's what we're doing here. And I believe, and I think I'm not going to get much of an argument that the traders really are entrepreneurs, and you need to manage your time like an entrepreneur would manage their time. So I want to give him credit. There are three types of days in this quote-unquote system. There are focus days, there are buffer days, and there are free days. And I'm going to go into each one so that we'll go into each one, and then we'll go into how to manage those days. Also, again, you want them to be fungible. You want them to be compartmentalized in your mind. You don't want to mix them. When you have a free day, you want to think about nothing about trading. You want to enjoy your family. You want to let your brain breathe. On buffer days, those are preparation days. Those are days you want to set up things for your focus. And free days and your focus days, you want to focus on one thing, and that's your trading and executing your trading plan. So let's get into it. Let's take focus days first, since that's really where the rubber meets the road. On focus days, you want to focus on trading only. Okay, you don't want to you want to consider your trading plan, getting your trading plan changed. You don't want to consider making any kinds of adjustments. You're there to do one thing on your focus day, and that is to run your trading plan as you've got it printed out. Okay, you want to execute your trading plan, period. Okay, so that's what that's what focus days are all about. You want to take your mental vitamin for your focus. Focus is important on trading days, and it really is all about focus, patience, and consistency. And what you want to do is take a mental training of some sort of a meditational, or we use our 7-minute mental training sessions to and there we have a special session on focus, a special session on patience, and one on trading consistency. And depending on how your week is going or your day before is going, if you found yourself losing a little bit of focus or losing a little bit of patience, then on the next trading day you would start your day with one of the mental trainings that would help you with what you seem to be wavering in. Okay, so if you had a little trouble with your focus on the day before, you would do a 7-minute mental training session on focus. And I can't emphasize it enough. You don't have to do ours. Ours are the best on the market and I see a number of people on the call here that do take our mental trainings. But you want to ground yourself, and you want to be in the moment when you're trading. You don't want to compromise that focus. Okay, and you want to journal before and after trading. You want to maintain. You want to maintain your consistency, and journaling before and after trading really helps you maintain your key strengths. And I'm going to get this is a good time to give you in just about every presentation, because most people say they journal but they don't. I want to give you now a quick journaling process that can get you started journaling right now. Okay, the first thing that you do when you start to journal, and I'm not talking about journaling your actual trades. You can do that on a spreadsheet. You can do that. I actually do that by I download my daily sheets every day, and I make notes on my daily statements on that. But my monthlies, of course, give me my winnings and losings, and it kind of gives me an idea of how I'm doing, as opposed to winners versus losers and size of winners. It's the reality. So I do all of that on the side, but that's not what I call journaling. What I call journaling is journaling your emotions, your ability to execute your plan. Okay, so the first thing that you do when you journal, at the end of the I'll start with the end of the day journaling. Okay, you want to start with something positive in your journaling. Today was a great day trading. Today was very consistent in my trading. I followed my trading plan and took every signal that my trading plan gave me. Okay. Then there's always something that you can improve in your trading on the day before, and the second sentence is where you express that. But you don't beat yourself up. You say today I did something that was unlike me. That's how I take responsibility, but I don't pin it on myself. I don't pin it as a brand. I say, this is unlike me. Today I did something unlike me. I didn't put my stop in when I first executed my trade, and that cost me. I wound up realizing it when it was too late. So tomorrow, okay, we're doing it at the end of the trading day. Tomorrow, I will be the stop king and place my stop immediately after placing my trade. And I always end my journaling with, I'm a wise and disciplined trader, and you can steal this from me. I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. Okay, I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. So you start out the journaling at the end of the day with a positive statement about what happened. Today I had a great day. Today I had more winners than losers. Today I followed. I took every trade as my trading plan gave me. I'm proud of myself for that. But I did something un-Norman-like. You don't have to use your own name. unnormal-like, or I did something that was unlike me, or I was beside myself for a moment. Those are the three phrases that I use: unnormal-like, beside myself, I did something unlike me. So I'm saying that I did it, but I'm not branding myself with it, because I want to light and airy to improve. This is all about staying positive and keeping a positive momentum about your trading. So something positive, something that you did unnormal-like, and it's good to give yourself a reason why that happened. I got too caught up in the trade, so I didn't put my trading, I didn't put my stop in. And then a corrective: tomorrow I will, a statement of tomorrow I will put in my stop as soon as my, I am, and I usually give myself a label. Tomorrow I'll be the stop king, okay? And then the ending sentence: I'm a wise and disciplined trader and do the things that a wise and disciplined trader does. Then on the next day of trading, the first thing that you write in the morning session before you trade, I do my mental training first, then I do my journaling, okay? And you can flip that. A lot of people that I work with do the journaling first, and then they do the mental training, and that's okay. But I think both need to be done before you start your actual focus and trading day. And so in my morning session for journaling, I'll put: today I rip it from the last sentence of the night before, the afternoon before. Today I am the stop king. I will be placing my stops immediately after my main position is placed, and I will manage my stops according to my plan. I am a wise and disciplined trader, and I do the things that a wise and disciplined trader does. So I use the morning as another stamp on a mistake. I don't want to keep making the same mistake over and over again, and neither should you. So the idea here is to make sure that that your journaling hits on something that's important to you, something and something that you can correct very, very quickly. And that's how I do it. I really want you to start journaling. I really want you to start using that the way if you're not journaling, just do what I've said. If you're not journaling your emotions and you're only journaling your trade winnings and losings, then I'd like you to start doing this. And just one other tip: don't do it on a couple of loose pieces of paper. Buy a nice book. Buy something that you can respect. I always use a leather journal, and make that happen for yourself, and really respect this corrective posturing that you're doing, that you're honoring yourself, you're recognizing your weaknesses, you're correcting your weaknesses, and you're ending with a statement of positive fact that you're a wise and disciplined trader, and you'll do the things that a wise and disciplined trader does. And the journaling only really proves that you're human, and you can get off track, and you can do something that's unlike you. It recognizes all of that, and it makes the statement. So enough about that. Okay, buffer days. Buffer days are trading education days. These are not now. You may, if you're an evening trader, you may take the first day as a buffer, the first 12 hours of the day as a buffer, and the second 12 hours for trading. Whatever you do, but trading days, I like to break up my days. I don't change my trading plan during the week. My buffer days are Friday, because I hardly trade on Friday, and on Sunday. Those are big buffer days for me, okay? And I deal with my trading education. I pick up some new, I watch some of these videos that everybody's got out that are free. Try to get in, I want to take in the education, okay? I review my trading plan on buffer days. I take a look at my weekly statement or my monthly statement, and if not the end of the month, then I gather my dailies, and I take a look at how my trading went, and I review some of those trades that maybe didn't go well, and maybe why, and is there a trigger that I'm using that seems to be that seems to misfire, and therefore maybe look to replace that trigger with another trigger. I use, if you're in our Simple Trading Plans course, then you know that I use the triggers that I use are primarily with candlestick formation. So, and there are many of those. Certain markets are more prone to certain candlestick formations than others. So over time, especially when you're trading a new market or a new stock or whatever, then your trading plan reviews and reviewing your triggers can be good news for you. I also review, and then I make my trading plans adjustments if necessary on buffer days. I do not adjust my trading plan during the week, okay, during focus days. I have total confidence in my trading plan when I'm trading. Train your mind to show up mental strengths and 5 key core competencies: focus, strength to pull the trigger, patience, overcoming losses, and overcoming the fear of greed. These are the fear and greed. These are the real enemies of traders between the ears, and these are the areas that we focus on in the disciplined trader, and areas that I'd like you to make sure that you're focused on these, what I call the 4 key mental competencies, mental and emotional competencies. So I do some extra training on those days because, yes, I do it in the beginning of the trading day, like I mentioned to you, on each of the focus day, or on a focus day. But I also am training on buffer days. Sometimes I'll do 2 or 3 sessions in a row. Overcoming losses. We've got some general tonics of being consistent. We have a lot of, if you haven't taken a look at the Disciplined Trader Mastery Kit, Google it, find it, and you go to the disciplinedtrader.com and check out the Mastery Kit if you don't already have it. But the idea here is to not let go of the importance of, not limit the training of your mind to the 7 minutes before you start trading. It's something that you should do a piece of every day. And I know my wife and I, we do a meditation when we go to sleep and when we wake up in the morning. Something about, there's one that I'm doing in the morning right now, and we'll talk about this some other time. But for instance, in the morning, I do a meditation. It's a 6-part meditation. The first one is realizing your own power, connecting you with the earth, and that we're not alone, that we are all interconnected. The second part of the meditation talks about gratitude, what I'm grateful for. The third part is forgiveness, where I forgive people that I've had conflicts with, and I ask for their forgiveness. And then the fourth part is visualizing a great future for the next 3 years, where I see myself. And all of these sections are only about 3 or 4 minutes long, so this whole meditation is only about 15 minutes. Then the fifth part is a meditation on what I'm going to do today. See myself eating breakfast, something that I'm going to do today that will serve that 3-year goal. And then the last is taking in is empowering yourself through the divine, or if you're a godly person, then taking the power of God. If you're not, then recognize your own inner power. But to get all these things done. But my point is, you do that kind of thing in the morning. It really sets you up to have a powerful day. Then I'm ready to, because in that visualization, I'm eating breakfast. I'm setting up my trading day. I'm taking my mental training. I'm journaling. I go through this fairly quickly. I've done this many times in this particular meditation, and so when I'm doing it, I'm just really living my dream. I've got it all planned out. So don't think that meditation is something that is only for hippies, as I used to think. As an engineer, I never was big for me, but I think that as I mellowed and as I was determined to be successful in my trading, especially about 15, 20 years ago, I decided to listen to my wife, who is one of the premier hypnotists in the country, even though, and sometimes your wife is the last one you listen to. That really has changed my outlook on life, my success as a trader, and I'm saying to you that don't hide from your own inner power, because that's what you're doing by not relaxing and exercising your full strength through something like that. Every great person meditates. Every great success, whether the Dalai Lama, the Pope, or Bill Gates, everybody's meditating. We might as well too. It really works, and you can do it in your own style. All right. Again, buffer days, forum participation. I'm not big on forums, but again, all of the things. If you're in the one Warrior, well, not the Warrior Forum, but there are trading forums. Clean up, and you want to clean up your messes. Look at your trade journal stats, as I mentioned. Look at any technical issues you may have had that you want to make sure doesn't happen while you're trading. Clean up your messes. And I use buffer days to look for long-term trends and cycles. I like, as I've been training brokers and coming out with, again, we've just come out with the with simple trading plans. If you want to take a look at simpletradingplans.com, we're re-releasing that soon. So get on the list there. Just go to simpletradingplans.com, and we'll let you know when that happens. But I'm looking for, looking to improve that. In that course, I talk about also we trade all time frames, but I like to trade the dailies because I can't stay on top of the market. So I look for markets on buffer days that are coming into a place where I may get a trigger. In other words, I alert myself to keep an eye on a daily chart on a daily basis, so that so when it's overbought or oversold, or one of the simple trading plans that we use, when I see it looks like it may conform to one of the triggers, I look for those charts. And I do that on buffer days is the point. Narrowing down potential 3 or 4 markets or stocks to trade on the focus day. Okay, and free days, very important. Free days. Remember, on free days, you do not want to trade on free days. I can't tell you how many times I used to I had like a half hour to do it in a day. I was and the markets were open, and it was a Friday, say, where I usually don't trade. And said, hey, why don't I just go to the market and make a few $100? I'll buy something and take a look. And you flippantly go on a day that's really not a trading day. You haven't done your mental training. You didn't do any focused work with your journaling, and somehow you just sit down. And it never works out. I mean, 9 out of 10 times you say, why did I do that? So if you're not going to prepare yourself mentally and emotionally to make it a trading day, and those are what focus days, you're better off trading less days and be totally focused. You're better off trading. I know some guys that trade 2 or 3 days a week and are doing fabulously because they see the power of the free days. Because on free days, when you're not trading and you're not thinking about trading, and you're with your family, and those are when ideas actually can bubble up, or self-empowerment bubbles up. You realize it's a time of gratitude where you're out in the grass with your family, and you realize that all your hard work is paying off. Everybody's happy, smiling, laughing, and this is the space you want to live in. And you want to appreciate that space, and you want to spend just as much time in that space as you want in your trading space. You don't want to compromise it by thinking about that last losing trade that you made, or maybe having gotten out of a trade too early. Let that be on the focus day. Do that on the focus day, okay? And you won't be doing a lot of worrying and concern, because your head will be straight, because you're going to be training your mind, you're going to be journaling twice a day, and you're going to be taking your trading days and your focus days seriously. So no trading. You've got to leave your mind alone. And again, this was Dan Sullivan talks about the importance of this. As an entrepreneur, he wants us taking 150 days off a year. Now, that may sound like a lot of days. But if you think about it, if you just take Friday and Saturday and Sunday off every day, that's 108 days. You got a couple of holiday weeks, and maybe 2 or 3 or 4 weeks of vacation. That's pretty good life. And you really can do that, and you certainly can do it as a trader if you can make your focus days and don't mix them up, and make buffer days, preparation days. On buffer days, you're preparing for your focus days by doing all the analysis we talked about and looking at charts and so on. And on the buffer days, you're also planning your free days. You don't even want to spend your free days planning your day off. You want to use your buffer days to plan your free days. So very important to take your free days just as seriously as your buffer days, which is you're taking just as seriously as your focus days, okay? No education on free days. No trading on free days. No reading trading books or articles on free days. That's a buffer day exercise, okay? That's total disconnect from trading, okay? And you'll enhance your creativity and ability to create results. I think my time is up. I kind of rushed through a little bit because we got a couple of minutes late start, but if I'm looking at my clock correctly, I just want to take this moment to thank you. If you want to stop by, if you're not on our list already and you want a lot of empowerment information. I'm not going to tell you where to buy and sell. I could tell you the structure of how to buy and sell at simpletradingplans.com, but it's thedisciplinedtrader.com is where you're going to get information like this. A lot of it is free. So just go to thedisciplinedtrader.com, get on our list, and just remember to be focused, and then use your buffer days, use your free days, and honor your time maybe a little bit more than you have been. So thank you very much for your time today.
Welcome back, ladies and gentlemen, at the Trading Summit 2014 on options and Forex. I want to introduce my next very good friend and speaker, Rob Booker. Just tell you a little bit about Rob Booker. He's actually has one of the #1 podcasts on iTunes. Also, #1 bestseller, Adventures of a Currency Trader, and also his indicators are used by tens of thousands of traders all over the world. Now, I love to hear also Rob Booker speak. I always get a kick out of it. I've known Rob do a lot of speakings, had him on Cyber Trading University many, many times. One of the more gurus when it comes to the currency markets and how to trade the markets. But he's also, one thing that makes Rob not just a great educator, but it's very enjoyable to listen and learn a lot about how to trade the market. He makes it so much fun, and that's one of the great things about being a great speaker and having a mentor is that you can actually relate to them and enjoy them and understand their personality, because we're all very, very similar. We're all trying to do the same thing, and that's making money. So, without further ado, I just want to pass the mic over to Rob. Rob, the stage is all yours.
Hey, everybody. I think you can hear me okay. Fausto, am I on there all right?
All good. We hear you loud and clear.
1, 2. And can you hear me okay? Well, I could try a different microphone here just to make sure. Hey, everybody. Just want to test my microphone before I get started here. Can you hear me okay? Well, I am just going to assume that you can hear me just fine. Hey, everybody. Rob Booker here. Happy to spend some time with you on this Tuesday morning. I want to thank Fausto and my friends at Cyber Trading University. I love these guys. Fausto is the real deal, and just always appreciate being a part of anything that he does. He's always got something fantastic going on, and he is probably the most productive member of the trading community that I know. He's just fantastic. Also, Norman just spoke to you from the Disciplined Trader. I hope you didn't miss that. He is awesome. He just told me that I should be taking 150 days off a year. That means I now have to work an extra 100 days, because I've probably been taking 250 days off a year. Anyway, I want to talk to you today about a strategy that works for stocks, Forex, and futures. So you're going to see a lot of images of a few different types of financial instruments, and it's going to work across the board. This is a strategy that I've been using for a while. I speak about it all the time, and it's really going to work across the board. And I know that the first reaction to something like that is, yeah, sure it works across the board, and no, it doesn't work across the board. That's impossible. It can't work for all of those financial instruments. That's totally impossible and ridiculous. But the fact of the matter is, the strategy does work across the board. Here's a picture of a sloth or something inside of a bathroom sink. I think that's hilarious. Anyway, it does work across the board, and I encourage you, I implore you to put this to the test. Everything that you see here today, go ahead and put it to the test. Throw it on your charts and see how it works for you, and then based on that, you make your own decisions. If you've got questions about the presentation today, there's a bunch of different places that you can go. You can go to a Facebook page that I've set up, and it's at facebook.com/Robbie Booker. So people used to call me Robbie when I was a kid, and that was the only easily identifiable Facebook page I could get. If you want to, you can go there today and ask me a question about anything from this presentation, say hello, etc., post a chart, ask me a question about it, and you can get some answers. Because I know you'll watch this and you'll say, I didn't have time to ask a question, or you didn't get to my question, or whatever. I'd be happy to answer your question, whatever it is. So jump on over there and ask me anything you want. So you might want to write that down. I'm not going to put this up again. I'm not going to try to sell you anything on Facebook or whatever. Well, maybe I will. I don't know. Haven't decided that yet. Today I want to have a little bit of fun, and I want to talk to you about a complete trading system. And so sometimes I get criticized because I have a lot of fun, and it doesn't sound like I'm super serious or whatever, but I really am actually. I'm in it to make money. I am in this to make money, and that's all I really care about. And I'm in it for you to make money, even more so. I just love traders, and I love it when you're making money. So I want to start things off with a quiz and ask you, what is this a picture of? So there you have the picture of, obviously, I believe this is the Hindenburg exploding into flames in the sky, and terrible tragedy, of course. And what else is this a picture of besides a giant blimp filled with hydrogen blowing up in midair? It's also a picture of my first trading account. I put this chart or this picture up in Madrid. I went to Madrid and Tokyo and Paris and talked to traders last month, and showed this slide. This is a picture of my first trading account. I don't know if you were a complete genius and prodigy in the world of trading from the moment that you started, but I certainly wasn't. And that's why I think I like Norman's stuff so much, that it really helps us address some of the more critical areas that we don't often get a chance to address in trading. Anyway, I was not a prodigy. I was just simply broke, and I thought I could make a lot of money trading. That was pretty much a stupid idea, and I probably should have just gotten a real job, but I'm somewhat opposed to having real jobs, and I've always either been fired from a real job or just stopped showing up. Really kind of hard for me to do that. I did take a job in 2008 at a broker as the chief market strategist. I loved everybody that I worked with, but I couldn't quite understand why everybody went into the office every day. So anyway, that was a picture of my first trading account. I did not do a good job. I started with $2,500 in a Forex trading account in the year 2000. In 3 weeks, I had made 10%, $250. But because I couldn't spend $250 on anything meaningful, I decided that I needed to increase my risk and rapidly grow my account much farther than that. I wanted to live off of that trading account. And although that's theoretically possible, and I'll show you a little bit more about that later, that's theoretically possible. It's a terrible way to start out of the gate, is to take early success, of course, and try to increase the size of the trades and then go nuts. And I traded like a drunken monkey, and I sort of woke up on the floor of my house, pizza boxes strewn all over the place in a fog. Kind of like in those movies where someone wakes up and he's killed somebody and he can't remember it, and then there's a manhunt for the person who really did it. Well, I was I woke up on the floor, and then I had destroyed my trading account. It was terrible, and I felt awful about it. And I spent about 11 months after that getting my stuff together, getting my mental game together, and back testing and building a trading system. And I've been doing this for the last 14 years. What kind of a trading system do you think is depicted on the following chart? So there's a chart. It's pretty busy, actually kind of a giant mess. In the upper left-hand section of the chart, you can see it's called the organ grinder chart. When I first saw this chart at a seminar that I taught in Santa Monica, California at the Fairmont Miramar Hotel in 2006, a woman pulled up this chart and she says, "What do you think of this chart?" And I said, "This would be a great chart if you were playing the piano on a street corner and there was a monkey on top of your piano, like grinding an organ or whatever, and this was your chart." Because it's just wild. It's totally crazy. There's all kinds of crazy stuff going on in this chart. And this is what my charts looked like for the first, I don't know, 10 months of my trading life. It was bizarre. It was, woo, it was impossible to make any money from this kind of a chart. And why do people put that many indicators on their charts? Oh my gosh, I want to poke my eyes out when I look at my charts that I used when I first started trading. Why would I put that many indicators on my charts? Why do they do that? Why do we put so many indicators on our charts and watch business television and have like cloud our mind with so much information? It's because we generally, especially when we first start out, we want confirmation. We want to know that we're doing the right thing. And that's an enormously typical reaction, and I have felt it, and you have too, from time to time most likely. We want confirmation. But I have some news for you. This is confirmation. There's a nice gentleman over here. Showed up for his son's confirmation. He's got that mustache and that little goatee underneath his lips and this just screams out, I have not been a part of my son's life at all until today, and I'm holding him here because he will run away if I let go of his shoulder. And as soon as I can get back to watching television on the couch, I am there. And you gotta love the extra sideburn action here that apparently he trimmed somewhat unsuccessfully earlier, and if we just draw this, we can, it's like a mystery. We can fill in the rest of the clues from this. Anyway, this is confirmation, and so is this. This is confirmation. Her dad, this fine woman's dad didn't even show up. I'm not even sure that a man could stand by. I don't know what the rules are. Anyway, we got the nice man with the cane, the Gandalf cane, and I don't want to be offensive towards religion, but this is confirmation. This is confirmation. That chart back here, that's not confirmation. This is evil, and this is good and religious. Evil and religious. That's the difference. All right. Here's a friend of mine. His name is Desmond, and he lives in Singapore. Desmond has up on his chart, on his screen right there, a very simple chart. I don't know what color your background is, but I am fascinated by the way everyone sets up their charts. But a fairly simple black background, just a few lines, pivots that we're going to talk about today, a moving average it looks like, and then some indicators at the bottom of the screen. Pretty simple, pretty straightforward. Desmond is a friend of mine, and he wrote me an email about, I think it was 2 months ago, maybe a month ago. Desmond lost his job in Singapore. He was making over $100,000 a year, and he was supporting his family. He lost his job. I don't know what the reason was, but he lost his job, and I've been there. And he started a challenge. He said, well, I don't have a lot of trading capital to use, but I'm going to try to turn $1,000 into $10,000. And of course, this is where you look at me with, your eyes are like, your eyebrows are way up on your head, and you're screaming, and you're like, no, and you're saying that's crazy, that's insane. Desmond is insane for trying to do this. And the answer is, yeah, he probably was a little bit insane for trying to do this. This is the ultra extreme of trying to accomplish something. We all want to make money, and sometimes we need to make a lot of money within a very short period of time, and we're not supposed to really want to do that. That's supposed to be too dangerous. Well, I have often said that anyone can really be successful at trading Forex. It's kind of like ratatouille. Anyone can cook. But the answer is most people don't, but most people can. But most people don't. Desmond, after 10 weeks, did turn that $1,000 into $10,000 and has continued to grow his account significantly. He says, I don't even follow your full rules of your trading system, but I do my own kind of thing, and I owe my thanks to you and Knoxville Divergence, which we will talk about today. Forever grateful, Desmond from Singapore. I just wanted to put that up, not to give you the idea that this is possible for you. This is an extraordinary accomplishment. Most traders will not be able to repeat it. Most traders don't do some of the things that Norman said in the previous presentation. I implore you to go back and watch some of his 4-minute videos. Most traders do not mentally prepare themselves. Most traders do not have a set system. Most traders increase the size of their trades dramatically after a small amount of success. But most traders, or even all traders, can be successful, and Desmond is the exception to the rule that most people fall under. And he did it, and he was successful. he did it with a system that I call trifecta. Trifecta is a trading system with 3 really easy and simple steps. I first introduced it in January of 2014, and it's now traded by over 2,000 traders around the world. Trifecta 3 launches this week. So they're kind of catching me in the middle of throwing up all these videos online into a trading course, and I'm just sort of full of stories from successful traders, and charts are all over the place, and this is the centerpiece of all of the trading that I do, and the system that I'm going to talk about today is the centerpiece of that whole system, and I'm going to share with you the complete strategy. The nice thing is it doesn't take me that long to do it because the strategy is very straightforward, and because we're here with Fausto, who I love Fausto, I'm going to give you the indicators that go with this, and I'll just give them to you. I'll show you the link where you can get them, and you can trade this along with us. And here you go. We're going to describe today what it means to take a swing trade setup on a trifecta trade. But you can also trade trifecta with very short-term trading and very long-term trading. I call short-term trading the danger zone because most people, well, including me, don't really care for it. It's kind of dangerous. And then swing trading is the sweet spot. I really love swing trading, trades that are open for between 24 hours and 1 to 2 weeks. And then what I call really big trades, long-term setups that can be open for months. Trifecta can do all of that, but we'll focus on swing trading setups. Trifecta is primarily used from traders around the world on options on stocks and on spot Forex and on futures. In futures, people love to trade oil futures, natural gas and oil futures with trifecta. Okay, so this is something for everyone here today. You can get the indicators for free as a download on tfl365.com. You can write that down or commit that to memory or watch this presentation later. You can also subscribe to these indicators on tradingview.com. Those are web-based charts that I have absolutely fallen in love with. Last of all, before we jump into the system, I do want you to know that this is the only trading system that I use and that I actually use it myself, and I think that it's important. One reason I really like to work with Fausto is that Fausto's a trader. He does it on his own charts, and he does it with his own money. And in the midst of all of the other things that he has going on in his life, as a father and a husband and an entrepreneur and a business owner and a teacher of traders, he's also actually committing money in the markets to the strategies that he believes in. He doesn't just talk about it. He actually does it. And this is a big deal for me. This is a sticking point for me, that you want to work with people and learn from people that actually put their money on the line and trade the things that you see them talk about. And I always envision that someone out there is Sheldon from The Big Bang Theory, looking at me like this, looking at me very skeptically whenever I talk about the markets and saying, yeah, right, Booker, sure you do, or whatever. And I totally understand that. So here's just a quick view today of the trades that I have going on. This is my live account. This is not a demo account. This is not a demonstration or practice account. This is a live account, and I've got just a bunch of trades open, and I'm negative right now. I'm down $3,000, which is really not that big of a deal, of course. But I've got trades on the Australian dollar, New Zealand dollar, the Euro pound, the British pound, Canadian dollar. That's not going well. It was going great this morning, and now it's going terribly. British pound, Swiss franc, and the dollar Swiss franc. So I'm committing real money to, and I do it every single day. I mean, I do this all the time to what we talk about today. So I'm not just talking about it and saying that it might break tomorrow, but what do I care? This isn't going to break tomorrow, and I will be trading this 6 months from now and a year from now and most likely 10 years from now. I think a great trading system is repeatable, it's tough, and it's simple. It's repeatable because you can depend on it trade after trade and you don't think it's going to break or it's not going to break tomorrow. It's tough because it's a system that will teach you how to get out of losing trades. I say a tough trading system is something that can stand the test of time, and that if it gives you a bad entry, if you take an entry on the system early or by mistake or whatever, the system is robust enough to get you out of that bad trade. We'll talk more about that a little bit later on. I also think great trading systems are simple. They're easy to implement, they're easy to understand, and they're easy to teach to your friends. Last of all, I think that a good trading system has a strong win percentage. Trading comes down to a mix of your win percentage and your risk to reward ratio. How often do you win, and how much larger are your winners than your losers? You could win 99% of the time, and your losers could be a little bit larger than your winners. you could probably make a trading system like that work. Or you could have a trading system that wins a lot all the time, and the winners and the losers are maybe equal in size to each other. There are a lot of variations on this, but I think that when you win often, you gain confidence in your trading system and you do better over time because you have confidence. And trading comes down, for me, to confidence. The confidence to pull the trigger when you're supposed to, and the confidence to walk away when you're supposed to, and not take a trade when you're supposed to. And that's why I think win percentage is so important. It's not the only thing, and I know risk to reward ratio matters. So in this trading system has a strong win percentage. It's going to win between 65 and 80% of the time depending on the financial instrument that you look at. And I've taken thousands of these trades, and there are 2,000 other people taking hundreds of trades a month using this system. And one of the great things about it is that it has a strong win percentage. So when you're looking at a setup, you're not going to sit around second guessing it and trying to overthink it. You don't want to overthink your trade. And when you have a strong win percentage, you can just take every single one of them and you don't worry about it. All right, let's get into the trading method itself. Looks like we have about 35 more minutes. It's probably not going to take me that entire time, but I'm going to try to show you a lot of charts, show you what I'm working on, and answer some questions that I anticipate. Daily pivots are at the center of the trifecta trading method. These are daily pivot points on the British pound, Canadian dollar. They're colored blue, and they have the letter P to the left. Daily pivot points are at the center of everything that I do, and they are the main principal focus of trifecta trading. On this chart, you can see daily pivots. You can see 4 of them. The outline of one to the left, and then a few more in the middle. The next chart is the Australian dollar, New Zealand dollar, currently kicking my hiney right now. I sold this early before I should have. We'll talk about that in a minute. And I got stuck into a trade, and I just took another trade this morning on it. The reason I took the trades, and the reason that I feel all right about having taken that early entry that was kind of a mistake or whatever, is that these daily pivots were not hit by price on the day they were created. I talk about this constantly and all the time, and anyone who knows me and has listened to me before knows that I'm kind of obsessed with this, and you probably get tired of me talking about it, but it's never going to get old, and it's never going to stop working, so I'm never going to stop using it, and I'm never going to stop talking about it. A missed pivot is not touched by price. You'll see here off to the right, there's a blue line, a daily pivot. That's been touched by price. You can see the candles jumping around that daily, that daily pivot. Candles moving through it, candles touching it, and so forth. You can see here these other 2 daily pivots were not touched by price on the day they were created. I call those missed pivots, missed by price, untouched, unscathed. You only know a pivot is missed at the end of the day. Why? Well, because it has the entire day to hit the pivot. So at the very end of the day, it could hit the pivot, and then it's not missed. So I spend my time during the day doing the following things: podcasting, watching Netflix, writing books about trading, playing with my children, and going out to eat, going on vacation, and so forth. At the end of every trading session in the world of Forex, which is either at 5 p.m. New York time or midnight London, a new pivot is formed and the previous day's pivot is complete. And I can walk through my charts and see what pivots have been missed and what pivots have been hit. It reduces my necessary trade planning time significantly. Missed pivots are important because price will always make an attempt to get back to those missed pivots. Notice that I'm not saying that price will always get all the way back to those missed pivots. I'm not saying that price is absolutely eventually going to hit this pivot on the Australian dollar, New Zealand dollar, but it's going to make an attempt to get back there. And that attempt is where the money is. Missed pivots create a counter-trend trading opportunity, and they can also create a trend trade opportunity. Missed pivots can be used for a variety of things, including profit targets, the reason to get into a trade, the reason to get out of a trade, and so forth. They mean a lot to me, and we'll talk about why. This is an example from the Euro-US dollar 15-minute chart in the world of Forex. It's where I do all of my trading, although I look at the stock market as well. I do my trading in the Forex market because it's open all the time, and it has, generally speaking, more volatility than some of the other markets. And huge liquidity, so I don't get stuck in a trade. Here at the bottom left, you can see a missed daily pivot circled in red. After just a few hours later, the Euro-US dollar made a drop. It dropped. It made an attempt to go back to that missed daily pivot, and it was successful, and it even went further. It's not always going to get back, but it's going to always make an attempt. Here's Amazon on the 60-minute chart. Amazon got crushed. Amazon is not an unprofitable company. I think Amazon in the last, 7 years has produced $6 billion in cash flow. It's not great, but Amazon is not an unprofitable company. They're just investing all of their money in infrastructure, and they're in it for the next 100 years. I do like Amazon. I'm not here to apologize for them having zero interest in profits in the short term, but I am going to say that Amazon set up a really neat missed pivot trade recently before earnings. Earnings came out, and earnings were okay, but they announced that they were going to lose $400 million to $800 million in the next quarter as they released the world's dumbest phone or something like that. I don't know. Whatever. They missed a daily pivot. In fact, they missed 2 of them. What did Amazon do after earnings? It dropped. Significantly dropped. Amazon is a stock that you can look at. It operates a lot like a currency pair. And everything that we talk about today is going to apply to natural gas or oil or Amazon or Apple or LinkedIn or Groupon or GoGo Wireless or the Euro-US dollar, the Euro-Turkish lira, the Thai baht, whatever you want to trade, it applies across the board. But a missed pivot is going to be hit. And after earnings came out, Amazon dropped significantly. And I suspect that Amazon will recover eventually, and I will be a buyer of Amazon down the line. Here's the strategy. The trading strategy is as follows. We want to use what I call Knoxville divergence to plan a trade in the direction of the missed pivot. Knoxville divergence plus a missed pivot plus a buy-sell signal equals a trifecta trade. 3 parts. Trifecta is like I think it's a betting term for the horse races. I don't really know. I don't do much betting or gambling. But anyway, I think it's a horse racing term, and it's got to refer to 3 things winning 3 things, whatever, I don't care. Trifecta trading is about 3 things. It's about divergence, missed pivots, and a buy or a sell signal. The setup is a 15-minute chart. We're going to look at Amazon today, I think, a lot. We're going to use Knoxville divergence, trend lines, and what I call reversal tabs. Now, all of these indicators are free. I'm using this term Knoxville divergence. Knoxville divergence is represented by these red lines that you see on my charts, underneath and above price. Knoxville divergence is momentum divergence. It's a divergence. It's when price is falling and the momentum indicator is rising. That's an oversimplification, but it will get us to the trading strategy quicker. I also use pivots in my trading methodology. If you go to that link that I showed at the beginning of the presentation, tfl365.com, I will give you these indicators for free. You don't have to buy them or anything like that. You can just get them for free. If you want to go to tradingview.com, they are available on tradingview.com's web-based charts as a subscription, and they're super inexpensive. But I have a partnership with tradingview.com, and I really appreciate them a lot, and I love their charts, so they do cost a subscription on there. That's just a matter of disclosure. All right. This is Amazon.com on the 15-minute chart, and here's what we're looking at. In area number 1, we have a missed daily pivot, a pivot that was not touched by price on the day it was created. This would work if you were looking at the euro dollar, the Japanese yen, or anything else you want to look at. Number 2, we see Knoxville divergence underneath price in two areas even. Knoxville divergence is an early warning sign that price is going to change directions. It's divergence. You could see Knoxville divergence underneath the candles, and that means that we should see reasonably soon a move up, or you can see Knoxville divergence above the candles, which means we should see a move down coming reasonably soon. Let's move on to another example, and I'll show you what I'm talking about. In this chart on Amazon, I'm showing actually just Amazon from April 2014 to the present. I show you every single setup, so we're not leaving anything out or showing you just the good examples or whatever. Number one, we see a missed pivot. Amazon rises during the day and does not hit its pivot. Number two, it prints Knoxville divergence, which is price is rising but the momentum indicator is falling, thus suggesting that the market is ready for a reversal. Number three, we break a trend line lower. Once that trend line is broken, we want to sell Amazon or buy a put, or you could even theoretically sell a call or do some kind of a put spread. Our goal then is to get Amazon to drop part of the way or all the way to that missed pivot level. And within 3 days of the sell signal, Amazon does drop that far. You could use options and gain some premium. You could earn premium by letting something expire worthless up here. You could buy a put and let something rapidly increase in value because it's moving very far in your favor quickly. Or you could buy a spread, and by buying a spread, you can lock in a certain amount of profit and you can cap your losses if things don't go your way. If you use an option, I would encourage you to set a strike at halfway the distance to the full target. This would be a perfect area to do that. If you're trading Forex, or futures, you're just selling here and getting out over here. Of course, you can also sell Amazon short. I'm not sure I would recommend that, but you could also do that. I would rather use an option and cap my losses. Soon after that drop occurred, while it was dropping on the previous chart, it was missing 2 daily pivots. That's fantastic. That's element number 1 to the trifecta trade. Number 2, it printed bullish Knoxville divergence. Number 3, it prints a buy signal. I call this green tab right here a reversal tab. I invented these, and they are simply tabs that show buy or sell trades. You get that for free plus an explanation of what it is when you go to the place to download the indicator. I don't need to go into it right now because it will just print on your screen automatically for you. And then Amazon starts to move up. Our profit target in this case is ideally the nearest missed pivot level that you see. Let's look at another example, Amazon on the 15-minute chart. This is the next example. As Amazon rises up from here to hit this profit target that we had just a moment ago, as it's rising up, it starts missing pivots. That's element number 1. That means we want to start to look for a sell trade. Number 2, we print Knoxville divergence, bearish Knoxville divergence, these red lines on top of the candles. Number 3, we break down through a trend line that we could draw. We sell Amazon, or if it's a currency pair, we sell the currency pair. If it's a futures contract, we sell the futures contract. Or we buy a put, or we sell a call, or we buy a put spread, or whatever we want to do, and then Amazon is dropping once again. It drops again, and you can see how this system, one trade leads to the next, right? So it drops, and then Amazon misses a daily pivot as it drops. That sets up a brand new trade for us. Number 2, we get bullish divergence below the candles. Number 3, we get a reversal tab or a buy trade signal right here in the middle, and we could buy Amazon right there. Maybe you don't want to do that. Maybe you want to draw a trend line across the tops of price and buy on a break of the trend line. Remember, you can use the trend lines to buy the currency pair, or you can wait for a reversal tab, which is part of the indicator package that you can download for free. Then you buy it, and then it starts to move up. You'll already notice off to the right here that as it moves up, it's missing pivots. That's fantastic. That means we know that in just a moment we're going to turn around and we're going to start selling this again, which is exactly what we do. In the very next chart, we miss a daily pivot as it's rising. Number 2, we print Knoxville divergence, bearish Knoxville divergence. It's printed on top of the candles. That means we have an early warning sign the price is going to fall. And then number 3, we get a reversal tab, a bearish pointed down reversal tab, and we start to move down. We move down to the nearest missed pivot. Now, at the time this trade opens, the nearest missed pivot is lower. And as you'll notice on this chart, we don't get all the way there. We made an attempt to get here. Well, maybe we did get all the way there. I don't know. It got pretty darn close to our profit target. And here's where I want to mention to you. Your goal as a trifecta trader is to get close to or halfway the distance to your missed pivot level, not necessarily all the way. It drops, and no surprise, as it's dropping, this was the trade we just took right here. As it was dropping, it missed a daily pivot. I just love this. I absolutely love it. But at the bottom here, sadly enough, we do not print any bullish Knoxville divergence, and there is no buy trade.
Hey, Rob, just really quick, we have to be ending in a few minutes.
Yeah.
You have to be ending about 12 o'clock.
Yeah, I'll do anything.
Sorry about that, buddy. Just said we have somebody else waiting. That's all. Apologize.
Oh, yeah, no problem. So you want me to wrap it up?
Yeah, can you please? Because it was like 30 minutes, and we had all the people waiting. Other speakers are coming up next. That's fine.
Yeah, no problem. Here, let me show you where you can download those indicators. If you go to the home page of TFL 365, you can download those indicators for free. And I'm so sorry. Usually it's an hour. So totally have fun, everybody. I want to apologize to the next speaker. Listen closely to whatever he says. Have a great day, everybody. Thanks for joining me.
University, am I broadcasting to the world? Somebody please give me a yes and we will get going. I am not seeing anybody. Can anybody hear me? Okay, guys, Greg McDermott for Cyber Trading University. It looks like I am broadcasting out. I'm not getting a reply from anybody. I think we should be broadcasting pretty well. Hey, you know what? Not a good spot for me to be in following Rob. That was some awesome stuff. I was hanging on every word. I was 1, 2, 3 writing notes, looking for the Knoxville divergence. I was enjoying that one. So I'm going to hopefully we can keep the energy up as we begin the second part of this. I guess a third or fourth speaker with a couple more behind me. So today we're going to take a moment. We are going to talk about the black-scholes model and options Greeks. I know a lot of you out there are probably a little bit concerned. You think options might be, too dangerous for you or too complicated for you. And I'm here to tell you that it's not. And we've been teaching options here for a while, and we've got we did an options phase 1 course a month or so ago. We're doing an option phase 2 course. And we take you all the way through the options. So what I'm going to do today is take one little piece, the much ballyhooed black-scholes model and those options Greeks. Now, again, I could spend an hour talking about one of the options Greeks. We've got 20 minutes. I'm going to give you a brief overview of what you can expect in our courses and in our teachings. So we are going to get going to keep us on schedule. The risk disclaimer. Our CTU risk disclaimer, everybody on the call should be very familiar with that. About Cyber Trading University, you're all familiar with Cyber Trading University. In order to keep us on schedule, we're just going to assume everybody knows that. And for those of you who don't know, that's my mother's favorite slide. She likes that one. Got my master's degree of applied finance from Macquarie University in Sydney, Australia back in '89. BS in financial management, was an options crude trader at the NYMEX, head options market maker for JAS Security at the PhilX, and ran our portfolio of risk. To get us back on track, I'm going to get going. We are going to talk about the black-scholes model. And the black-scholes model is, or was, developed by Fisher Black and Myron Scholes first brought to light in their 1973 paper, The Pricing of Options and Corporate Liabilities. They used this model to determine a way to hedge options using a ratio of the underlying security. Options had been around. This model was the first to give us a way to take those options trades that were out there and to develop a way to hedge a position. At its very core, it's the model that begat all the models that have come since then. There are now, and you'll see why, not an infinite, but thousands of different versions of options pricing models based on some of the original. And as most things happen, the first model is not normally as all-encompassing as subsequent models. And what happened was, first model came out and it had some assumptions. Those assumptions were European exercise. Well, what's a European exercise? For those of you familiar with options know, that means that you cannot exercise the option until expiration. There's a different type of exercise which all U.S. equity options use, which is an American exercise. In American exercise, you can and have the right as an owner exercise that option at any point up to and including expiration. So for stocks, this assumption a little bit weak, which again brought us to the more advanced models that we have today. The risk-free rate and volatility remain constant. Risk-free rate remaining constant, well, for the last, since December of 2008, the prime rate's been 3.25%. We could say that in most environments, it doesn't necessarily have to be constant, but the risk-free rate is relatively well known as an input into this model. The part where volatility remains constant is one of the downfalls of the model. I can tell you that 20 years ago when I used to be a clerk at the New York Mercantile Exchange, our technology back then was so limited that we would have to print sheets at our post and then physically run the paper out to our traders. And if volatility moved, we would get a new order of change these volatilities, run back to the post, print out the paper, run back to the post, and hand them to your trader in the crowd. So volatility does not remain constant. Again, bringing us to more advanced models. Stocks pay no dividends. For some stocks, that's true. Other stocks, that's a problem. Markets are efficient. I'm hoping there's no one snickering out there. But the assumption that markets are efficient brought us to the beginning model, this black-scholes model that led us to the options trading and the derivatives trading that we have today. Now, everyone calm down, take a deep breath. There will be no test at the end of this. I know some of you are having heart palpitations right now looking at this model. This is just the math behind what makes the black-scholes model run. And although it looks pretty scary, a large majority of the factors that are built into the black-scholes model, as I noted earlier, are well-known, easily defined. We know what the time to expiration is because we know an option expires. Most options these days, they're regularly scheduled equity options, using that as our example, expire on the Saturday following the third Friday of the month. So we know how many days it is until that expiration. So time is not a real factor. We know what the underlying price is at any point. We just bring it up on our screens. We know the strike price of the options that we're talking about because we picked a specific strike to develop our options. We know what the risk-free rate is. So a large portion of the values needed to determine the value of an option, a call or a put, are well known. Volatility is normally the piece that takes it from science to art. Coming up with that volatility number, whether you use implied volatilities, and this is where the models go crazy. You'll hear people talk about, skews and smiles, and how do you price the value, the options? Because in the old days, a lot of people would price their options if the volatility was, the at-the-money vol was, 20. You would have people who would price their options at the far ends of the spectrum, the deep out of the money calls and the out of money puts at the same value, and it could give you mispricing. So that's become more of each strike, call, and put can be modified for its value. And you can find those implied volatilities by using any trading system that's out there will give you options pricing. You can get implied volatility on there, without a problem. So most of the pieces, surprisingly, are relatively easy, are relatively well known. It's the cumulative distribution function, that standard normal distribution, that plays a little bit, that we take that into the figuring out the dividends, and that volatility piece. But all in all, at its core, a relatively simple function. And what this model gives us is the ability to take those options values and create other options and create synthetic positions. And what do I mean by that? Well, if you take a three-sided position in stock, if you lay this position out, this is a risk-free position. If you're long stock, long put, and short call, you have a zero risk position. You have built a synthetic stock short versus a synthetic long stock. And what I'm going to do is I'm going to show you the math. Anyone here that's gotten through 9th grade algebra can tell us how we could move the S plus the P minus the C equals 0. We could move that around to get us some other values. For example, how would you come up with a synthetic long call? Well, if you'd move the short call to the opposite side, you'd have, and I'm not going to try to draw on here in order to keep us on time, but you would have long stock and long put would be equal to a long call. And the answer is at the bottom. Stock plus put on the left side equals a long call on the right side. And what does that mean to you? What's the impact for you on this on this equation? Well, what it shows you is that our top left graph here is the graph, is a graph of a call. This is the theoretical P&L graph of a call that cost $4 on the 50 strike. Now, down at the bottom, you have the theoretical P&L of a long stock and a long put, the put being at the 50 strike, that costs $4. They're exactly the same. So what does this mean to you? Well, if you had a long stock position, and let's say it was going your way, but you wanted to protect some of your downside, you could create a call simply by buying a put. It would give you a P&L that would look exactly like the top left graph at the bottom right, without having to necessarily sell your stock out, buy a call, transaction costs, those sort of things. So it allows you to move, in this case, from stock to options and back and forth, creating different positions. What about if we wanted to have a synthetic naked or short put? Well, we move the put to the opposite side, and it tells us that long stock and a short call, minus call, is the same position as a long put. And let me show you that on a graph. And here we have it again. Up in the top, we have long call, short stock. We've capped our profit above the 50 strike. Again, this is a $4 value and a 50 strike. This shows you that a long call, short stock position at the same strike is equivalent to, until expiration, a naked short put, which means you make money if the stock stays at 50 or above on a short put. Below that, you begin to lose money if you are the seller or the naked side of a short put position. And what about synthetic stock? Let's say you wanted to create a stock position. Well, let's get the calls and the puts on the opposite side, and that would give us our stock. And what that's going to give us is long a call and short a put is going to look exactly like a stock position. And that stock position, you can see, long stock, you go up and down exactly with the underlying based on the movement of the stock. Whereas if you have a long call short put position at the same strike in the same month, you would have exactly the same P&L. Now, why would you own long stock, or why would you own long call short put instead of long stock? Well, that's a question that needs to be dealt with in a phase 2 kind of class, and we will talk about that. But there are times when it's less expensive to own a long call and a short put versus a long stock. Can anybody think of a very, very expensive stock that everyone knows about that rhymes with Boogle. Well, you're right, Google, as an example. Now, I'm not telling you the only reason that you should trade a stock, that you should trade options is because you can't afford the stock. That's not what I'm saying. But if you want to trade Google stock, you could trade with a long call short put position that would cost you significantly less than the almost $900, what was it, $890-ish yesterday, something like that, that it cost per share to own the stock. So sometimes you can use your capital more wisely, creating a synthetic stock position, whether it be long or short. Another reason you may want to have a synthetic stock position is some stocks you can't short. They're hard to short. You can't hit a down tick. Well, you could create, as you could see here, I'm sure anybody could do the reverse math on this. If you're short a call and long a put, you then have a synthetic short position. And what that synthetic short position is it would look just like it would look the exact opposite of this. If you were, this is if you were long it, but if you had the opposite, you would be short it also. So those are the reasons why. Let's get to the options Greek. There are four that that bring about the most common four Greeks that we have, and the biggest one would be delta. Delta is called the rate of change. It goes back to that original Black-Scholes model when we talked about the ratio of stock to or underlying to option. It's the hedge ratio. And what that means is delta runs from 0 to 100. An option with 0 delta will not change in value versus the underlying. A delta of 100 means that the price of the option will change by exactly the same amount as the underlying. So delta runs from 0 to 100, 0 being no movement with the underlying, 100 being a fully in-the-money option, whether it be a deep-in-the-money call or a deep-in-the-money put. Normally, you're at the money options, right where the underlying is trading at those strikes. Normally trade about 50 until we get towards expiration when those can skew a little bit. Another way people look at the delta, they will also talk about it as the percentage chance that an option will expire or close in the money. If you have a $50 call and the underlying closes at $51 at expiration, that option was $1 in the money. Well, 2 weeks before expiration, that delta could have been about 60, and making up numbers, 60 would tell you you had about a 60% chance at any one time at that time that that option would end in the money. Delta gives us the ability, let's say for example, you own 10 calls and the Thinkorswim model tells you that you've got a 500 delta in your long 500 deltas. To square that position, to hedge that trade, to minimize your risk, you could sell 500 shares of stock versus the theoretical 10 calls or 1,000 that you have control of if you're the owner of the call. You'd have sold 500, squared up your position, hedged it, limited your risk. And as the underlying moves, you would adjust accordingly. If it goes down, you would probably be shorter and buy back some of those short deltas. If it goes up, you're going to be able to sell more of the stock. So it tells you how much is the value of the option going to change based on the movement of the underlying. The next piece is gamma. I like to refer to it, it is the rate of change of the rate of change, and it tells you how much is your delta going to change as your underlying changes. So in the example we gave before, something that's a 50 delta and the underlying moves up a point, it's not necessarily going to be worth 50 cents more. It could be worth 55 cents more. Well, how did it get there, Greg? Well, it's gamma. It's how much does your rate of change. I also like to talk about it's the measure of the velocity of price change. Think about positive gamma as being a good thing for the movement of the underlying, negative gamma a bad or difficult thing to manage on the downside. By the way, options usually, if you own options, you are long gamma. If you are sold options, you are short gamma. Vega measures the effect in the price change of volatility on the price of an option. Talked about it earlier. Vega being volatility being the one real wild card. As your volatility moves, you will impact the price of an option significantly. and you can use this Vega number to measure the risk of a portfolio of options as well as the risk of an individual options position. The last one is theta. It's well, no, it's the second to last one. Theta is the measure of the effect of time. It's time decay. If you buy an option, all things equal, it's worth less tomorrow than it is today because time has passed. The clock is ticking as soon as you buy an option. Decay is always negative. It always goes away. Of course, if you sell options, that decay works on your side. Think about it as sand through the hourglass. It's always going away. If you own options, it's a race against time to get your options in the money before they expire. And the last one, the measured effect of interest rate movement on the price of an option. It's rho, interest rate. Very rarely does it impact, but it can. Interest rates haven't in the recent past changed very significantly, but it can impact if we go to a higher rate environment. It then can significantly impact the value of options. Look, we are getting it back on track here. We'd like to invite you to call our educational advisors. We're offering a $29 cyber group purchase. You get to join the cyber group for 10 days. I'm going to be in there after the expo today, the trading summit, talking about my normal FX and options look-in. So I'll be in there today after 2 o'clock before Fausto gets on. Call today for $29. You get for 10 days, if you're serious about trading, for 10 days you get to jump in and watch people trade. Our screens are up all day long. Fausto jumps in twice a day, gives his commentary. I join once a day, midday normally. So for $29, if you're really serious about becoming a trader, the best way to learn is to watch other people. And there's no better way than for us to open up our screens and tell you live, hey, here's what we're seeing. So this is Greg McDermott for Cyber Trading University signing off. I'm going to throw the ball back to the team in New York. We've got our next presenter on board and ready to go at 12:30.
Some charts around here, so I apologize very much. Let me do something here and see if I can get the proper screen on. Bear with me just 1 second. My name's Chris Irvin, and I am looking forward to spending some time with you here today, talking a little bit about options. I heard some of what Greg was saying there, and that was pretty exciting information, and I think what I'm going to do is I'm going to actually be able to pick up and move forward with some practical application of the things that he was talking about today. But first, I've got to figure out how to get my screen on the right side. And I'm having a struggle with that. Bear with me just 1 second. All right, I am back. I apologize about that brief delay, and I think we're good now. Greg has let me know that we are all set to go, so I appreciate that very much. Hey, I want to spend a little bit of time talking today about how to make money in the market without picking a direction, but before I do that, it's probably a good idea if I just let you know a little bit about who I am. My name's Chris Irvin, and I'm the Director of Options Education here at Market Traders Institute, and I created something called the Ultimate Options Course. So I have spent time traveling around the world, being a commentator for various broadcasts and a writer for various blogs and financial websites, and I've taught literally thousands of people around the world how to best use options to make money in the market. So that is who I am, and I look forward to spending the next 25, 30 minutes with you right now. And as I said, I was listening to Greg, and Greg seemed to do a fantastic job of outlining options. And what I want to do is just spend a little bit of time taking some of that knowledge that he laid out for you and sharing how we can actually use it in the market to make some money, especially right now during earnings season. Now, as we get started here today, I want you to understand who Market Traders Institute is. Market Traders Institute is a company that has actually was founded about 20 years ago in 1994 and is in Lake Mary, Florida. We have over 100 employees with 30,000 clients, and our mission is to create successful traders. So that is our hope each and every day, that we can help you guys become successful traders in the market. I would love to know how many of you are doing well in the markets and how many of you are struggling. But I will tell you this, throughout my experience teaching people how to trade options, I have come across many people that have struggled with the option side of things. Now, what I try to do with folks is not necessarily get into all the Greeks and all the various things that can be somewhat confusing to people because they feel like they have to learn everything about options before they can make a trade. The reality is, what I want to do for folks is to help them start to make some money in the market. And one of the easiest ways to do that is in probably the most volatile time that you'll find in the market, and that is during earnings season. So here's what I want to know. If you all were to look at a chart like this, I remember back in the day that there was a situation with Tesla where everything was looking positive with Tesla. The trend was up. Everything was looking great. And I think somebody got into a trade and caused that trade to just drop like a rock. Now, if you remember, dropping like a rock after you get into a trade to the long side, it is a very frustrating thing. You know, ultimately, it feels sometimes like there are people out there that are just watching you, waiting for you to make a trade, and once you do make that trade, they take the market the other direction. And that is incredibly frustrating. How about this? Are you the one who maybe got in Chipotle Mexican Grill in a short position, and you were expecting it to continue that move to the downside, and then all of a sudden it popped to the upside? Was that you? I mean, I used to feel like that all the time, where I'd make a trade, and the market would go exactly the other direction. How about Netflix? Are you the one that said, you know, I'm thinking about buying some of this Netflix because that stock might go up, but you know what, I think I'm going to watch for a few more days and just kind of see what's going to happen with Netflix, and we'll just see how it plays out. I'll give it a little bit more time, and then all of a sudden it took off to the upside while you're standing there watching on the other side of the trade, not in the position. You know, I'm not sure which is worse, to actually get into a trade and have it go the opposite direction, or to be standing on the sidelines and actually have it take off in the direction you anticipated, but you're standing on the sidelines watching it and all that profit leaving your pocket. Well, you know what? As we look at those kinds of situations, a lot of it comes down to just being uncertain about getting into a trade, right? Trading options sometimes can take us to a place where we are so concerned about getting into the trade because of being burned previously that we just suffer from, what do they call that, paralysis of analysis? Well, I think I've actually come up with an opportunity for those of you that if I ask you, are you a decisive person, you might say maybe, because you're not sure. You see, that is the mark of an indecisive person. Well, here you go. I want to give you something to think about as far as a specific strategy that can be used right now to make some money in the market. So we want to talk about actually how to make money in the market without picking a direction. Now, if you're not going to pick a direction in the market, can you possibly make money? And the answer is yes. And there is a specific strategy called a straddle out there that will allow you to get into a trade, have 2 of 3 directions that a stock can move covered, and you actually increase your possibilities of making money by 1/3. So if you picked one direction and you know a stock can move up, down, or sideways, that would mean that you have 3 directions the stock could actually move, and you got 2 of the 3 covered, that means you've increased your odds of being a winner from 33% to being 66%. And this is the type of trade that I really love. Now, what do you have to have in order for a straddle to work out? You actually have to have a stock that's going to move. So a straddle is a great opportunity that allows a trader to take advantage of a known event with an unknown outcome. And right now, we are sitting smack dab in the middle of earnings season. Earnings season is a fantastic time for people that can't make decisions in the market because they give us opportunities to trade events that are on a calendar that we can look at, make an appointment to make the trade, and check the trade the next day and see if we've made our profit. So you don't have to be around in these trades very long. You can put your trade on one day, take it off the second day, and you can make anywhere from 10 to 30 to 40% or more overnight within 24 hours. Now, that's the type of trading that I really like to do. I've got some set it and forget it kind of trades. I teach this thing called the go moment style of trading, but when it comes right down to it, the ability to make money immediately is a great opportunity when you're talking about a straddle. So here's what I want to do. I want to show you a couple of charts and give you an idea of how straddles work. Now, those of you that have spent some time with straddles previously, I want you to hang in there for just a second because I'm going to show you something that maybe you haven't seen before about a straddle. Those of you that are new to options trading, I want you to think back to some of the things that Greg said previously about the delta and the movement and time decay and those kinds of things as we go through this progression here. But ultimately, I want you to understand that a straddle is a very simple trade, and that's what I'm into. Simple, easy to follow strategies that make sense and have the opportunity to make money very quickly in the market. So here's an example of Facebook. As we look at this chart of Facebook, you might have difficulty trying to figure out which direction Facebook is heading. Is it heading up? Is it heading down? We could say that the overall trend is maybe heading down and we've moved a little sideways. We could say that we bounced and we started to move back up, but the reality is it's a very difficult chart to read. Now, if we're looking at this chart and I threw in one more tinker into the whole perspective on Facebook and told you that the next day I happen to know that Facebook was going to have their earnings announcement, that would cause a lot of people to back away from any type of trade on Facebook because the uncertainty of what's going to happen after that earnings announcement can really cause traders to be fearful of the market. Because if they take a directional trade, they have about a 33% chance of being correct in the trade, and that's not enough to make a good trade. But if you do something called a straddle, that just means that you're going to buy a call option and you're going to buy a put option. Now, based on some of the information that you heard already, if you buy a call option, you realize that you're taking advantage of the underlying stock as it moves up, right? So calls go up, all right? If the stock moves up, the call makes money. If the stock goes down, you understand that the put makes money. So a straddle is going to be a combination of the two. You buy a call and a buy put at the same time. Now, if you've got a call and a put, that means that you've covered both sides of the trade. So what do you have to have happen in a straddle? Well, you have to have a stock that actually makes a significant move. What's a significant move? Somewhere between 10 and 15% after their earnings announcement. So it's really important that you don't try to put a straddle on every single stock out there that you know of. You have to be definitive about the different stocks that you choose to put straddles on because they have to have a history of moving significantly. So what are we going to do here? You buy the call, you buy the put, and then go to good night's sleep because you got both sides of the trade covered. Now, once the company declares their earnings, in this case Facebook, I want you to understand that Facebook the next morning went through their earnings announcement, the stock popped pre-market, and it opened up $11 higher. That was a 20% move overnight. Now, if that happens, you say, well, Chris, how in the world does this straddle thing work? Because aren't you losing money on one side and making money on the other side? And the answer is yes. The call option in this case was making money, and the put option was losing money. But there's something really cool about that thing called the delta in an option. All right? I'm going to explain how you'll actually make money in this trade in just a second. I think that's the piece that a lot of people are concerned about when they think about a straddle, if you've heard about it before. Let me just show you how this trade worked out. Okay, on the 29th, got into the position, bought the call and bought the put. On the 31st, sold the call, sold the put. That ended up being a profit of $225.96, and the reality is I've actually made more in a trade than $225.96. But option traders, really you shouldn't be focusing as much on the dollar amount of your trade that you made. You should be focusing on the rate of return. You see, this trade, this straddle, resulted in a 26% rate of return in 2 days. Now, if you could keep building that rate of return by 20, 25, 30% over a couple of days at a time, you would end up with a pretty decent trading account over, I don't know, 6 months, 3 months. I don't know how much money you need. But the reality is straddles are great opportunities because you can get in quickly and get out quickly. You know exactly what you're doing. You take two sides of the trade and you increase your profitability by 33% because you're taking 2 of 3 possible directions the stock could move. So what's the problem? If a stock doesn't move, what happens? Well, that's how you'd lose in the straddle, and that's why it's so important to pick your straddle opportunities wisely. So let me show you exactly how and why this straddle works. All right. Now, the straddle, again, is a strategy that allows a trader to take advantage of a known event with an unknown outcome. Now, earnings announcements are excellent opportunities to trade straddles, and that's exactly where we are right now. As a matter of fact, this afternoon, I'm going to send out an alert to all of our clients to let them know which straddle we should be placing this very day. Now, prior to the announcement, we're going to purchase equal numbers of calls and puts to create a delta neutral position. So what's that mean? In order to create a delta neutral position, we have to understand a little bit more about the delta. Now, I know Greg spent a little bit of time talking about this, but bear with me for just a second if this is review. But if it's brand new to you, I think it'll be well worth your time. All right, delta is the Greek letter that's used to describe the change in derivatives in both science and mathematics, and it is the first letter in the Greek word diaphora, which means difference. So when we talk about making or looking at the delta in an option, we need to understand that the delta is really telling us how much that option is going to increase in value based on a $1 move of the underlying stock. Now, ultimately, when we're looking at a straddle, it's real simple, because what we're going to do is we're going to buy options that have delta of 0.50. 0.50. Now, that's to the call side. The put side is going to be a negative 0.50. All right? Calls are positive deltas and puts have negative deltas. Now, if you were to add a positive 0.50 and a negative 0.50 together, you'd end up with 0. That is a delta neutral position. So when the announcement is made after you've bought equal numbers of calls and puts at the money, which means 50 delta on the call and negative 50 delta on the put, the one option is going to increase in value and the other one's going to decrease in value. And the profit is made when the winning option increases at a rate that is faster than the one that decreases in value. And you say, well, how can that be? Well, let me show you. The delta actually moves in a very succinct progression, okay? Greg had a comment about what was called the gamma. The gamma is important, although it's not really important for us to know the idiosyncratic, I guess that's the right word, information about the gamma. What we need to know is that the delta doesn't remain static. As the value of the underlying stock increases and decreases, the delta is going to increase and decrease as well. That's what it comes down to. So let's go through this example. If I had a $50 call option, now $50 is a strike price on that call option, this is what I want you to understand. If the stock was currently trading for $30, and these are all hypothetical numbers just to get the point across, if the stock was trading for $30 when you bought that $50 call option, then you might have a delta of 0.10, which means that if the underlying stock moves $1, then your hypothetical delta is going to make you 10 cents for every dollar move of that underlying stock. Now, as the value of the stock increases, and say it goes up to 35, your delta is going to increase. So let's say at this point your delta is now 20, and that means that you're going to be making 20 cents for every dollar move of the underlying stock. And we can continue this process until we get to $50, which is going to be considered the at-the-money strike price. Okay, the at-the-money strike price is just when the strike price of the option and the value of the stock are basically the same, okay? Now, when that happens, you end up with a delta of 0.50, which is exactly where we want to start our straddle. All right, if the underlying value of the stock continues to increase, we go to what's called in the money. So now the stock's worth 55, and we've got some real meat on the bone with our option because we have the right to buy the stock for 50 bucks, but it's worth 55 right now. So we're starting to make some money on our option. Now, if you look at the delta has moved up to 0.60. And then it goes to 0.7 as the value of the stock increases, 0.8, 0.9, and so on and so forth. So the point here is just to understand with a call option, as the value of the underlying stock increases, so does the value of your delta. All right, you start making money faster and faster. Now, let's take a look at the same scenario, but let's look at it now from the perspective of a put. Because puts, as you already know, probably, increase in value as the underlying stock decreases in value. So let's say we buy that same $50 strike price, but this time it's a put, not a call. Well, let's say that the stock is at $70 right now. Because the stock is trading for more than our put, and remember we're expecting the stock to move down, let's say that hypothetically our delta is at a -10, all right, which means we're going to make 10 cents for every dollar move of the underlying stock as it falls or increases. Now, as we continue this process, it's going to work just like the call, except backwards, okay? As the value of the stock falls, now we're at 65, we're going to be making 20 cents for every dollar move of that underlying stock. If we drop to 60 in the value of the stock, our hypothetical delta allows us to make 30 cents on our option trade. As we continue on down to the at-the-money strike price with a put, again, we'd be making 50 cents for every dollar move of the underlying stock as it falls. So we keep moving down, and you see the delta increases in value. Now, I know there's a negative in front of it, and most of the times you'd say, well, a negative means that it is actually getting smaller, right? And I get that, but here's what I want you to think about with the negative in front of a put option delta. It really just means that there's an inverse relationship between the movement of the stock price and the movement of the option, the value of the option. So it's an inverse relationship. As the value of the stock goes down, the value of the option increases, the put option increases, all right? Now, why have I shown you all this? I want to show you how the value of the options move, whether it's call or put. Because once I take those two options, a call option and a put option, and I put them together in the same trade, which is a straddle, here's what happens. This is great. We start out with a positive 0.50 delta and a negative 0.50 delta. That means that we are delta neutral in our strategy, right? Delta neutral. All right, so that means that each move cancels the other one out. Well, what would happen if an earnings announcement came out on the particular stock that I have my call and put on, my straddle trade, and let's say that the stock came out with incredible earnings, everybody loved what they heard, and the stock price increased, shot up. It'd look like this, right? Let's say the stock goes from 50 to 65, increase of 15 bucks. You'll notice that the call option on the top would now have a delta of 0.80. And again, it's hypothetical, but just to get the point across. And the put option would actually have a negative 0.20 delta. Now, let's take the negative out there and just take those two deltas. We don't need to take the negative out, actually. And we take the 80 delta and subtract 20 from it. We end up with 60 cents. The net between the delta of the call option and the delta of the put option at this point is going to be what we're going to make. So net-net, we'd end up making 60 cents in that trade. Hopefully that makes sense to you. Now, here's the other side of it. What happens if the earnings announcement comes out and it's terrible earnings, and the market hates what they hear, and the value of the stock falls from $50 down to $35? Well, that's good news for the straddle trader. Why? Because now I've got a negative 80 delta for my put, and I've got a 20 delta for my call. The difference between those two is 60 cents to the side of the put. Again, the put's increasing in value here. So again, I'm making 60 cents between those two options because I just subtract my loss from my winner. And I end up making 60 cents per dollar move of the underlying stock. So in reality, what I've done here is I put myself in a position where if the stock moves up, I can make money. If the stock moves down, I can make money. If it remains stagnant, that's the only time that I'll lose. But again, that's why we want to be pretty diligent about looking for the proper candidates for our straddle trades. But I'm telling you, if you have problems making decisions about which stock you should get into, about which direction you should be getting into a trade, if it feels like the market is watching you and every single time you get into a trade, the market turns over and goes the other direction on you, you got to learn how to do straddles. I mean, what does it mean to do a straddle? I mean, we know the basic concepts, but it's really this simple. There's two different kinds of straddles. One is 1 day prior to the company's earnings announcements, go long equal numbers of calls and puts. Literally, the day before or even the day of. Let's say that there's a company that has earnings this evening. All right, I could put on this straddle anytime from now until the close of market, and I would have the opportunity to make money tomorrow. All right, so you don't have to plan these things way out in advance if you don't want to. You can just put the trade on the day before and check it the next day. And when I put a straddle on, I wake up the next morning kind of like a kid rushing towards the Christmas tree, wondering what Santa's left under the package. You see, before I understood straddles, back in the day when I first started trading options and didn't really understand them and learn to work with them properly, I used to be scared to death every time I put a trade on because I didn't know what I'd wake up to the next morning. Well, when I put a straddle on, that all goes away. I really like straddles, as you can tell. All right. Now, in this case, if you're going to buy equal numbers of calls and puts, okay, at the money calls and puts, you also have to decide how much time you need to buy. And for me, I like to buy at least 2 to 3 months worth of time. Typically, it's about 2 months worth of time. This means that if the trade doesn't work out precisely the way it should the following day, I've got some time to let it work out. I got both sides of the trade. I can let it go. And I had to do that last earnings season. Not every trade worked out perfectly. There were a couple of trades, and this is highly unusual, but I was in them for 20, 30 days before I got them to work out. Eventually, they did. So actually, I had one that went against me. It was Facebook. They don't all work out, okay, but most of them do. Now, the other opportunity when you're trading a straddle is to trade 30 days, put the straddle on 30 days prior to the company's earnings announcement. And again, you're going to buy equal numbers of calls and puts, but you're going to do that well in advance of the earnings announcement. Why is that? Well, the reality is what you want to do is in this particular straddle opportunity, you want to buy your options when they're cheap. What's that mean, to buy your options when they're cheap? Well, there's something called volatility that plays into an option. Now, we don't really need to get into all the details about volatility. You know, volatility basically tells us whether or not a stock is going to move up and down significantly based on what it's done in the past. So is it going to be more jumpy in the future, or is it going to be within the mean of the movements over the previous period of time that it's been jumping around? Do we expect it to get really hyper? Well, I tell you what, if that's the case, if volatility is high, then you're going to pay more for your options. The closer you get to an earnings date, the more volatility is going to increase, the more people are going to expect the volatility to increase. So your options get a little more expensive. If the volatility is low, say 30 days before the earnings announcement, the options premium is going to be less expensive. That's just what it comes down to. Now, there's two different types of volatility, and I don't want to get into all of this about volatility, but there's really the two types are historic volatility and implied volatility. And ultimately, I'm going to skip through a couple of these slides because I know I'm running out of time. Here's what I want you to understand about volatility. This chart right here is a chart of volatility. Now, you can get this chart in a lot of different places. This one happened to come from Options Express, but it doesn't matter. You can get them lots of different places. What I'll share with you here is that there's a really easy way to figure out if an option is cheap or expensive. You see, I've got a blue line on this screen here, and that blue line is the implied volatility. That's what somebody thinks is going to happen in the future, okay? The red line is the historic volatility. All right, the red line is objective information. Looking back in the past, we can see what the numbers were on the stock, and we can make an evaluation based on those solid numbers. Objective information. The subjective information is the blue line. That's what the market maker is looking out in the future and saying, yeah, I think the stock's going to move around quite a bit. If you have the blue line above the red line in this case, then the options are going to be considered to be expensive or overpriced. If it was the other way around, if the blue line was below the red line, then the options would be cheap or inexpensive. So ultimately, when you're trying to take option number 2 from the straddle, you're trying to buy options that are cheap versus, or when it comes to their implied versus historic volatility. Now, most of the time, I don't worry so much about that. I just have to give you both sides of the trade. What I do is I put my trade on the day before and let it work out overnight. That's what I do when I straddle things. Now, volatility does have a large impact on strategies, and I've had people say that you can't put on a straddle the day before and have it work out because volatility will eat you up. I beg to differ because that's the way I do it. So buying a straddle prior to the increase in volatility is going to reduce the cost of the trade, but it doesn't mean that the trade won't work out if you just buy it the day before. So where do you find straddle opportunities? Well, there's earning calendars out there like Yahoo Finance. In this case, you can see that it's from 2013, but you'll find earnings announcements posted in earnings calendars all over the place. In this case, Tesla Motors is here. This is a trade that I got into. I showed you this picture previously at the beginning of my presentation, and I'll just show you what I did. I got into the position, bought the call, and bought the put. It looked from that chart like it could continue to move up, but the reality was that after the earnings were announced for Tesla, everything looked good as far as revenues go, but the reality was they were having problems meeting the demand of their batteries. So they had a shortage of lithium-ion batteries, which was causing them to not be able to get the cars out the door like they needed to, and that caused people to run for the exits. Now, when I started this trade the next morning, I was actually down $530, but I didn't panic about this because I know that the market maker is going to mess around with these prices just a little bit. So the next day, or excuse me, towards the end of the trading day, I was only down $120. The following day, Tesla reported a third fire, which can never be good for a business, and I see that now I'm up $443 on the trade. Now, as I continue to monitor it throughout the day, and again, this is the second day, the day after the earnings announcement was released, I'm up $460, and then I start to see things start to tick against me a little bit. I'm up $380, and I decide to check in on my charts, and I notice that based on some technical analysis that we teach with the Ultimate Options course, I see that there's old resistance becoming new support. I see that there's a 50% Fibonacci retracement that the stock has caught. So I just say, you know what, I'm just going to take my profit. So I closed out the position, ended up making $229, 6%, not the best trade I've ever made, but I ended up in it for about 3 days. Now, Netflix is another great opportunity. Netflix moves around quite a bit, and you can see I showed you this illustration previously, a big move in Netflix after their earnings announcement. How did that one work out? Well, bought the call and bought the put. Ended up doing that on the 22nd, and on the 28th, I finally scaled out of the whole thing, ended up making $1,629. That was a 33% profit in 6 days. Not bad. I like that a lot. I got Tesla again. This is another Tesla illustration. So I'm buying the call and buying the put with Tesla. Before the earnings announcement, Tesla moves up $20 higher. That's 11%. That was good enough to make some decent money in the trade. This one I stuck around in a couple of days. I get in on the 19th, out on the 26th, and I end up making $2,881 worth of profit. That ended up being an 88% rate of return in 7 days. Now, my question to you is there an opportunity for you all to trade straddles? Now, I have to tell you right now, I'm running out of time. I just got a few seconds left. And actually, I've gone overtime by a couple of minutes. I apologize about that. But what I do want you all to know is that I have to hop on another webinar at 1:15, and I would love to have you guys join me. Now, I know that the previous presenters have given some great information for you guys, and I know the next person up is going to give you some great information as well. So out of courtesy to that person, I would love for you to stick around and listen and glean all the information you can from that person, and then jump over into my webinar. Now what I'm going to do is I'm going to give you the link, or send the link back to the main guys there, and let them pass that link out to you. Now if you just click on that link about about 1:30? Yeah, 1:30. You will have missed about 15 minutes of the intro, but you won't miss the meat and potatoes. So I would encourage you to do that. Out of all due respect for the next presenter, I apologize for being late on this thing, but I also want to let you know that I'm sure they've got some great information. But please join us. We'll talk more about straddles in my 1:30 or my 1:15 webinar. Love to have you, and we'll talk to you soon. This is Chris Irvin, wrapping it up.
Just confirm that audio is okay, and you guys can see my screen using options to trade spot FX. I'll know to get started right away. Everything seems okay. Fantastic. All right. Thank you for the introduction. My name is Christopher Vecchio. I'm a currency analyst with Daily FX Research, and we want to bring you a little bit of perspective on how you can use the options market to get perspective on trading spot FX. Now, we're not talking about trading FX options here. So if you've come for that, I need to apologize. This is I need to share my screen. Let me just make sure that it is up still. Let's see. Show my screen too. All right, should be up now. Seems to be good to go. All right, and again, using options to trade spot FX. We're not trading FX options, but we're looking how to use the options market to not up again. That's disappointing. Let's see here, screen, monitor 2. How is this now? It says that it's up on my screen here. Sorry about this issue, folks. Just want to confirm this really quickly.
Let me just try something really quick for you. Hold on one second.
Just a moment there. Sorry about this. Okay, trying again now. It says it should be up again running. Second screen here. Thanks very much. Let me start fresh because we've clearly fallen a little off the wayside here. My name is Christopher Vecchio, currency analyst with the we're not talking about trading currency options, but we're talking about using the options market to identify trading opportunities in spot FX. Now, just before we jump in, I just want to go over this quick risk disclaimer. Obviously, trading FX is extremely risky. It carries a high degree of risk, may not be suitable to all investors. You've heard this 1,000 times before, but high degree of leverage can work with you and against you. So before you consider any investment decision, you should be aware of all the risks associated. Anything that you hear from me, just like from anyone else, including that great presentation from Chris Irvin, just an opinion, news analysis, and doesn't constitute investment advice. But Chris Irvin's presentation leading up into this was perfect. I couldn't have asked for a better precursor than what we actually had coming in right now. Let me just check this here. Wonderful. All right. So this is my favorite chart to start off with, the FX trading market. And this is really what separates FX as an investment class from other instruments, so to speak. In stocks or bonds, everything is centralized. When you want to go place a trade, you call up your broker, who then sends off an order to someone at the New York Stock Exchange, and you receive a quote, and that trade is placed. In FX, it's not like that whatsoever. A retail trader goes to his broker, who receives quotes from various banks, who are trading with one another. It's this giant web that's really intertangled, but there's no centralized trading hub. Now, that's good and bad. It's really a function of how big the market is, which means there's a lot of liquidity out there. You don't have to worry about, say, spreads widening out if you were trading Apple after hours and the stock was trading at 98. Because of the illiquidity in the market, you might have to pay 98.50 to get the stock. That doesn't really happen in FX. We're talking about 1, 2, 4 pips here. All right. But the difference is when you have all that information in a centralized place, it gives you certain tools that are available for technical analysis. Now, one of these is volume, and I think volume is probably the biggest indicator that FX traders don't have that other traders that are trading, say, the S&P, or if it's corn futures, or even if it's something like Apple, they have volume. And so this is a chart here with the volume positioning, so to speak, of the S&P 500, and it's pretty basic. You see that during downtrends, volume picks up. You see that during uptrends, volume has deteriorated over the last several years. This is a chart that's straddling the end of 2010, middle of 2011. But this would be great if we could say, well, how does this affect the euro dollar? Okay, why would we care? Well, in this last chart that we showed, it was pretty clear that higher levels of volume were associated with significant turns in the market. We just don't have that available to us. I promise you that I'm not just avoiding showing the volume indicator here. It's simply on a market level does not exist because of that lack of centralization. Now, one way to get around this, a little bit of a circumnavigation, if you will, would be to use the CFTC's Commitment of Traders data. The CFTC's Commitment of Traders reports show positioning not just for FX markets, but for commodity markets. They tell you who's long, who's short, whether or not they are dealers or asset managers or speculators. And that's really important to us because we want to know where the money is flowing and when. Now, something that you might see from an anecdotal observation, I encourage everyone to go out there and look at this when they can put their hands on data, but you'll notice that speculators, those non-commercial entities, take a different side of the trade than those commercial entities. Commercial entities are traders who have a bona fide reason to hedge. So what does that mean? Well, let's say you're a British exporter and you sell goods in the United States and you're worried about the pound appreciating, because if the pound appreciates, then those American consumers won't be able to buy as many British goods with their US dollars. So therefore, you might want to see, as a hedger, in this case a bona fide hedger, you'd be willing to buy those British pound futures so that in case the pound rallies, any lost revenue or any lost profits that may have come your way from the diminished volume of sales, you'll make up in the futures market. Now, that's really useful because you see where these big corporations, these big entities, believe the market's going. And quite frankly, those are the players in the market that are going to push around prices. Speculators, on the other hand, they tend to take the opposite side of the trade. They see people piling in on one side. They want to fade the move. Now, there is an inherent limitation of the CFTC COT data. We can look at individual reports. We can look at the position sizes. But this isn't timely information, and this is by far the biggest drawback to using this data, as well as it could be for a weekly trader or a daily trader, depending on your time frame. For someone who's looking at an hourly chart, a 4-hour chart, trading intraday, intra-week, it's not really that useful of a tool. It's not a good market timing tool at all, and it's truly only useful to gauge broader and long-term trends. So I think this is why at least I use FX options as an alternative source to help fill in the gaps with the CFTC's COT data. Now, we've had a number of presentations already today covering options, and I'd just like to go over some of the basics because there are several factors that influence the price of an option. We're going to be focusing on volatility specifically. I think there's 6 main factors that are affecting an option: the price of the underlying stock, the striking price of the option itself, the time remaining until expiration, the volatility of the underlying asset, the current risk-free interest rate, and this can be measured against something like 90-day treasury bills, and then if you're trading stocks, the dividend rate. We don't really have dividends here in FX. You may be collecting rolls, but not in this low volatility, or rather low spread environment when interest rates are near pegged to zero. But these same factors that are affecting other options are affecting FX options as well. Now, I just want to review the very basics with FX options because they differ a little bit than the traditional stock option. The core tenets are the same. If you take on a call option, it means that you're embracing a bullish view of the market. A call option is an agreement that gives the investor the right to buy but not the obligation of an instrument at a specific price within a specific time period. On the flip side, there are put options, and as you might have filled in the blank already and trying to rush me through this, bearish view and an agreement that gives the investor the right to sell but not an obligation the underlying asset at a particular price. Now, the one thing that Chris Irvin was touching on at the end of the last presentation, which is probably the most important thing to consider, would be delta. Delta is the change in the price of an option, in this particular example, a call option, for every 1 point price of the underlying security. Now, why do we consider this the most important option? Because if the asset price is far above or far below the striking price, the other factors have very little influence. Its dominance, delta's dominance, is clearly obvious on the day that an option expires. On that day, only the asset price and the striking price of the option determine the option's value. Pretty much the other factors have no bearing at all. At this time, an option is really only worth its intrinsic value. Now, staying with delta for a second, delta is or can be seen as a hedge ratio. Now, let's say the price of a call option with a hedge ratio of 40 will rise 40%. That's what it means. If the price of the underlying stock increases, you typically see that those stocks or those assets with those high hedge ratios, they're usually more profitable to buy than the ones with the small hedge ratios. And why do we say that? Well, if you have let's say a 0.5 versus a 0.1, it's to say there's a 50% chance versus a 10% chance of this actually moving and responding in the direction that you believe it will. There are also various concepts with respect to the price of the option: in the money, at the money, and out of the money. At the money is when the strike price of the option is equal to the market price of its underlying security. Let's say that the strike price is 136 and the euro dollar is trading at 136. Well, then you could say that this option is at the money. If you're in the money, that means the strike price is below the current market price. So again, if the euro dollar strike price is 136 for this call option and the euro dollar is trading at 136.50, current market price, that means this option's in the money. On a put, it's the exact opposite. If we're trading a 136 euro dollar put, that's the strike, and the current price is 136.50, you're out of the money. If it's trading at 135.50, you're in the money. That's important because moneyness is a very important concept for options traders. When you are in the money, you're seeing that delta is increasing at a greater rate, and when you get to that option expiry date, you are running into a situation where even though the other 4 factors may not matter, because you're capturing the intrinsic value of the option through the asset price being above the strike, this is going to be a profitable trade. Now, it's not just simply the 136 strike. There are other factors that come into play. There are the premiums through the other factors. So really, you might be paying, say, 136.15, and that's when we start to see the value of the option increase. At 136, you're just at the money. Now, let's say the exercise price is 136.15. Once we get through 136.15, that's when you start to see your option come into the money, so to speak, and the rate of gain increase. Delta is low when you're out of the money. Delta is high and increasing when you're in the money. Now, when we're talking about options, and I think this relates very closely to what we're seeing today, volatility is an underappreciated factor right now. That's to say that because Vega is so low, some of these option strategies are actually a little bit cheaper. So I really truly think that when you're looking at the market at present time, you need to be paying attention to those options that are closer to a present day. Because volatility is so low, it's suppressed. You're not going to be getting the true value of what the market's reflecting. But just like with Delta, volatility is positively related to the underlying movement of the asset. Higher volatility, a higher option price. Lower volatility, a lower option price. Now, why do we care about volatility so much if delta is what's giving us the juice out of our trade? Well, volatility as a concept is a major part of the Black-Scholes options pricing model. Now, I could talk about the Black-Scholes options pricing model, but it's going to bore me, it's going to bore you, and you really don't need to know much about it besides the fact that volatility is positively related to the price of the option. Rather, I want to introduce you to this concept of the volatility smile. Now, volatility smiles are patterns in implied volatility that arise in the pricing of these options. In particular, for any given option, options whose strike price differs substantially from the asset's underlying price, they command higher prices and thus higher implied volatilities than what's suggested by these regular standard option pricing models. When you see this occur, these options are said to be either deep in the money or deep out of the money. Now, why would we want to graph implied volatilities against strike prices that exhibit this skew? Well, I think when you're considering what's going on, you have actually a good perspective on where traders that are trading options believe the market will go. So let me pull up an example here. This is just a simple volatility smile, let's say for the euro dollar. And if you notice at the various intervals, let's say the 20 call or the 20 put, the price is higher for the puts than the calls. Now, what does this mean? It means that traders are willing to pay more for aggressively out-of-the-money options on euro-dollar puts than they are for out-of-the-money calls. Relatively speaking, the implied volatility priced is more expensive for the puts than it is for the calls. This could be a situation where we're seeing something like today, and this is purely hypothetical, but the euro-dollar is sliding. It's on the verge of testing 134. If we're talking about, say, a front week expiry, we're saying something's going to expire this week or let's say even next week, given the fact that we've seen the market fall already, those longer out-of-the-money calls, let's say 137, 138, they're going to be cheaper than the ones that were priced, say, at 134 or 135 2 weeks ago. And that's important to us because it shows where the market participant is leaning with his particular bias. Now, how do we apply this? And how do we translate this into actually reading the market? Because we could talk about volatility smiles, and it's such an abstract concept. But really, this feeds into risk reversals. And if I don't talk about anything else the rest of the day, and quite frankly, I don't think I'm actually going to, because this is such an important concept to using FX options to guide spot trading, take notes on this risk reversal concept. Now, risk reversals are a measure of a volatility skew. A risk reversal is basically a strategy in which you are being short and out of the money put and being long and out of the money call, both with the same maturity. A risk reversal is a position in which you essentially simulate the behavior of a long. It's sometimes called a synthetic long, if you will. Now, while you're buying these out of the money options and puts, or out of the money options calls and puts at the same time, you can see whether or not the market is leaning in a particular direction. Now, what do we mean by that? Let me point some things out here on this chart. up here, we see that the risk reversal percentile has reached a very high level. That's to say there is a premium for buying those options on the long side. Let me see, get these charts here. We also note that when risk reversals are high, the 1 month and 3 month risk reversals run high, we see that they happen to coincide with tops in the instrument. In this case, euro-dollar, and we're looking at a euro-dollar chart from 2009 to 2010. So when risk reversals shoot higher, we note that these are occurring at tops. On the flip side, we see that risk reversals are lower, they're cheaper, when euro-dollar is trading lower. Now, how can we use this to predict price? Well, just based on that simple graph I showed there, I want to outline just a little bit of a basic strategy. You buy the euro-dollar when the risk reversal's 1 year percentile hits 5. You close the long position if it hits the 45th percentile. You sell the risk reversal when the 1 year percentile hits 95. You close the short position if it hits the 55 percentile. How does that actually look on this chart? Well, that's to say, when you're here, you want to sell. Risk reversals are running high. There's a good chance for that turn. On the flip side, the lows in price, the bottoms in the market, are occurring when these risk reversals are bottoming out. And so I drew this median line here in the chart to just show where the 0.5 would be on that risk reversal percentile. So basically, the strategy says when risk reversals are at the top of their percentile, that's when you want to look to sell price. All right. How would this actually work out, though? Well, back-tested this basic strategy, and I can't tell you this enough. Hypothetical performance has its inherent limitations. There's no representation of account here that's achieving this profit. This is purely back-tested material. But taking a look at this equity curve, we take a look at how this strategy performs simply by buying and selling the extremes, almost like a range trading strategy in the risk reversals. Euro-dollar turned this basic account essentially from a zero starting point, we'll say $10,000, ran up to a little over $20,000 in profit, even as high as $45,000. You have to adjust these strategies, though, for individual currencies. It's not just a one-to-one. I want to point this out, and running too far, for the pound dollar. The same exact strategy in which you are buying and selling at the 5th and 95th and closing out based on the 55th and 45th percentiles. This was a terrible idea in pound dollar from March 2006 to March 2010. It simply did not work. So how can you predict price then? Well, you can adjust your parameters, and I think you should do this with any indicator. You could buy the currency when the risk reversal hits the 95th percentile from last year. You close the long if it comes back to the 70th. You sell when the risk reversal's 1 year percentile hits 5. Close the short position if it comes back to the 30th. This is an example of Aussie dollar. And it just shows here how over the long term, it's not necessarily going to indicate the right move in the beginning, but when you let the strategy run, you may be able to glean some results from it. Now, when we're talking about these hypothetical performances, it's super important to know that market conditions are always changing. Right now is a particularly difficult time to be trading spot FX. I'm not going to lie to you. This is probably the most difficult market condition I can remember over the last 7 or 8 years. And I want to say that including the 2008 crisis, because at least with that high volatility, the market was moving. Now, with low volatility, it leads investors into this sense of complacency. What do we mean by complacency? Well, people see the market's not moving. I think we saw a 15 pip euro-dollar range yesterday. It was the second lowest range we've seen over the last 2 years. Why does that matter? Well, when traders are looking for, say, 50 pips of profit a day, I'm just throwing out a number there, and they come back and they see the market's only moving 15 pips a day, they might be enticed into a situation when volatility stays low to increase their leverage. Instead of taking, say, 10 lots to get their 50 pips because the market's only moving 15 pips on average, they increase that to 30. lots. Now, why is that a problem? Well, when you're using more leverage, you also expose yourself to greater downside. And I think right now, with where the market currently sits, we're almost entering that zone where people have become so frustrated with the low volatility environment, seeing increased leverage on the table. In fact, if we were to look at something, and I can't measure this unfortunately from the FX market standpoint, but I can look at it from the stock market standpoint, New York Stock Exchange margin debt, which is essentially traders borrowing money to put on trades, has reached the highest levels, eclipsed the highest levels from the 1999-2000 stock bubble, from the 2007-2008 peak in market. So why is that a problem? Well, when volatility is low and traders are leveraging up, it exposes them to greater losses in the case of something happening out of the blue. Become so complacent with the current conditions, traders often forget that events can appear out of nowhere. I think this week is particularly interesting. There is a accumulation of event risk that's going on. I mean, we could talk about Ebola in Africa. We could talk about the 6 or 7 wars that are going on across the globe right now. We could talk about economic data in a very much less serious sense. We could talk about economic data. I like to call this week acronym week because of the amount of U.S. event risk on the table. Tomorrow, ADP, GDP, FOMC. We have NFPs, PCE, ISM on Friday. All these events have the underlying nature to drive volatility in the market. And because of how low market action is right now, I truly believe that we have been lulled into this a sense of all's well that ends well. There's nothing to be concerned about whatsoever. Now, where does this all tie in? Because I'm moving more or less away from say, options and talking more about just general market commentary. But you need to be able to adjust your trading strategy depending upon the conditions that present themselves to you. Now, just like I showed that pretty pathetic pound-dollar strategy in which the same strategy that was applied from euro-dollar just lost money hand over fist in pound-dollar, when we took that Australian dollar strategy, and again, just for a simple reminder, we were looking at when the risk reversal hits the 95th percentile from last year, buy, close a long position if it comes back to the 70th, sell when the risk reversal's 1 year percentile hits the 5th, close the short position if it comes back to the 30th. Actually turned out to be a better strategy for pound dollar. Now, these are cherry-picked examples, and quite frankly, don't take away the cherry-picked examples. The example that you need to know here is that these tools are available, but it's not a one-size-fit-all. I hate when I hear people say, and of course, the fine gentleman that we're presenting today did not bring this view to the table, and that shows to speak to everyone's experience and quite frankly, intent on presenting the most valuable information. Anyone that tries to say to you that I have an indicator, I have a trading strategy that's going to make you money in any environment, no matter what, they're trying to sell you something. It's just not true. Breakout traders are having a real difficult time in a pair like dollar-yen this year. Right? Range traders are having a difficult time in Kiwi dollar over the last several months. But range traders would be apt in the dollar-yen environment right now. It's been trading between, what, 101.30 and 102.75, but for a handful of days for the past 5 or 6 months. On the flip side, Kiwi dollar has gone up from 84 up towards 87. Now it's back down to it. I saw an 84 handle at some point today, trading below 85. But these conditions are always changing. And you know, right now, I know it's difficult to say you should be paying attention to volatility because volatility is essentially non-existent in spot FX. But volatility and the way that traders position themselves with respect to options, they can tell you which way the market's leaning. And so I don't think it's a good idea to outright dismiss the low volatility environment. I think this is a great environment to learn in, to learn about other market conditions. You know what the worst time for me to pick up a book was? When I tried trading in 2008, 2009. I can tell you that my worst trade ever came during August 2011 when the S&B raised that floor in Euro Swiss franc. And you can't see me right now, but I'm shaking my fists eastward as being in New York, right at Switzerland. Those conditions make it very difficult to learn new trading styles, to learn new trading strategies, to bring a new perspective into the market, because you always have to adapt. I think right now is the best time for education. When the market seems slow, it's a summer day, it's pretty nice out here in New York, I think I'm going to go outside and read a book on some trading strategies to improve my knowledge. The options market is a wealth of information to learn from. And that's important because there's no volume in FX. I want to amend that statement, actually. There's no volume in FX markets generally, but as I'm going to pass on a link to Fausto in a little bit to send you, FXCM has actually unveiled its own proprietary volume indicators. Now, why would we care about that? Well, FXCM is the world's largest electronic online broker, and so we have a fair amount of clients that are placing trades throughout the day. And you can actually see, not just by volume size, but by transaction size, what clients are moving money around when. So FXCM is currently working on a solution to this no volume data in FX markets. My colleague David Rodriguez has put together, a quant trader strategist, put together a litany of information on how to use it. And like I said, I'm going to send that all over to Fausto in a little bit. The volume indicator for myself is changing the way I look at markets, but you need more. FXCM, even with its $4 trillion plus in trading volume last year, is a drop in the bucket. You know how big that bucket is? It's $5 trillion per day now. And our data only reflects $4 trillion per year. So even if we have our own proprietary volume indicators, it's still missing something. You can fill in the gaps with the COT data. It's helpful. It's not timely. Options can help fill the void. When you look where people are positioned, when you see where they're expecting volatility to run, it's more or less an indication of where they expect the spot price to move as well. And so in times like this, when we're looking at these spot markets that are in low volatility, we can turn to the options market as a way to capture what the underlying sentiment may be. And sentiment in the market is so important. I spoke about sentiment in the market back in February at another one of these seminars. It was a tremendous opportunity to speak to the CTU crowd, and I welcome the opportunity to speak here again. And the big takeaway from that sentiment presentation was it doesn't matter if you think this is going to happen in the market or that's going to happen in the market. A great example would be Treasury yields at the beginning of the year. Myself included, I thought that U.S. yields would move higher. If you looked at Bloomberg surveys, I think it was 71 out of 71 economists thought that U.S. interest rates would move higher. We'd see the 10-year yield trading up about 3.3, 3.5% at this time during the year. But you know what the one thing that everyone overlooked was, and hindsight being 2020? Positioning. Everyone in the market was short already. There was literally no people left to sell treasuries. And when there's no one left to sell, well, that means there's a big opportunity to buy. And I can tell you that the 10-year yield and the 30-year yield, they're confounding everyone. The 10-year is below 2.5. The 30-year just hit a 13-month low. And that's why positioning is important, because it didn't matter that economists and Wall Street banks and X, Y, and Z were forecasting higher yields. Positioning and sentiment is what pushed the market around. It's the most important thing. It doesn't matter that Jay Carney told you to sell Russian stocks. I believe from his call a few months back, Russian stock market was up 20%. All that matters is positioning and sentiment. And so to review, because of the lack of volume data on a day-to-day basis and intraday basis we have in FX, given the size of the market, considering that COT data is not timely, it comes out on a weekly basis, and even then we get it on Friday, the reporting period is for Tuesday, we need something else. And I think by looking at option volatility and these volatility smiles and the skews, you can actually get an indication of where the market's leaning and give yourself a little bit of an edge, so to speak. So I know this is a little bit of an abstract view of what's going on. My colleague David Rodriguez was actually at the FXCM Expo presenting about this. He spoke for 40 minutes on this very topic. There is a link here, and I can give that faster as well. If you're looking for an in-depth look at options, a more drawn-out conversation, David Rodriguez's video is still up on the FXCM Expo website, and he can walk you through that presentation as well, covering a lot of the similar slides as well. I like to keep it consistent here. The one thing that I do want to cover before we go, and I want to make sure Fausto gets this, would be that look at that FXCM volume indicator. Fausto, as far as I'm concerned, spot markets right now are on the verge of waking up. The last few months have been so pitiful in terms of movement, but summer months have gone by, the World Cup's gone by. Now we're talking about the Bank of England raising interest rates. Now we're talking about the Federal Reserve raising interest rates, maybe both central banks being behind the curve. There's nothing better to inject volatility into the market than misunderstanding or mispricing of future events. And right now, given the environment that central banks have created, whether they push yields down low, spreads have been narrowed and compressed, trading volume has died as a result. And if you think about that, that's very logical. If spreads narrow, then essentially then the range at which you should be expecting prices to move is a little bit narrower. That means that there's a diminished need to hedge. If there's not as much hedging activity going on, there's simply not a lot of flow in the market. If there's not a lot of two-way action in the market, there's not a lot of alpha generation opportunity. But we may be reaching the tail end of that. And so right now, when the markets start to wake up, and as traders aren't necessarily willing to put on those positions in the spot market, maybe we see the options market start to pick up a little bit more. Maybe we see that come a little bit more alive. And I know that I'll be looking at the options market a little bit more closely over the coming days and weeks to gauge whether or not some of these moves that we're seeing the last few days are for real. Eurodollar is waking up. Dollar CAD is waking up. Pound dollar is waking up. For all those traders that have been asleep for the last few weeks, myself included, there's never been a better time to look at the market because everyone is thinking that everything is going to stay low for long, and that's when expectations are ready to be thrown askew. So I appreciate everyone's patience for me today. I'm sorry for the frazzled nature of my presentation. That whole technological issue at the beginning really threw me off my kelter, but I really appreciate Fausto coming back in here and saving the day. That's why he's in charge of all this, and I'm merely a peon in the whole operation. If you have any further comments or questions and a more in-depth view of what's going on here, obviously couldn't cover everything as we'd like to have to. See VecchopFX on Twitter. That's probably the best place to reach me. We're sharing charts there. We're talking trade ideas. We're commenting on news, data, incoming events. You can always email me, cvecchio@dailyfx.com. Let me just send this link over to Fausto here on FXCM volume. Actually, I can send this to everyone, I believe. All right. So Fausto should have that link for the FXCM volume app. I'm also going to send over the report that David Rodriguez had written on the FXCM volume app so that you guys can get a better sense of what's going on and why you should add that to your trading repertoire. And just sending over this last link right now.
All right, Chris. Well, thank you so much for that great presentation. I think I just posted that link for everybody, Chris Vecchio. I'm just going to post it up again for Daily for FX. So hopefully everybody could see that link that's up there. And it's always like to thank FXCM for help sponsoring this Cyber Expo. We do every twice a year here at Cyber Trade University. Also want to do one last quick announcement for everyone. Hopefully everybody could see this really quick right now. One thing that FXCM, as also a promo, what we're doing is there's a grant And basically, with a $20 opening up a $20 deposit, we are going to FXCM is going to pay. We were allocated this money to go towards education, and it's an FX grant where you're going to get $4,000 in training. All you have to do is open up $20 to find out more about that grant. All you need to do is click on this link, and you can register right now. So if you're interested in the grant, definitely be interested and register soon before the money's used up with that grant. Now, once again, FXCM is sponsored by them. They're paying for your education. The thing that they want you guys to realize that if you know what you're doing and if you're educated, because they know the biggest failure rate of trading, 90% of people fail in trading because they don't know what they're doing. But if you learn and go through our program, you'll be a client of FXCM forever, and they're willing to pay for your course. I wish there was a lot more brokerage firms that made an investment like this, but there's an opportunity for you guys to benefit from a grant. That's right. So click on that link, register on it. It's $4,000 of education that FXCM is going to be paying you for, and you're going to be getting all this great content and all this live training from Cyber University from our friends at FXCM. So click on that, and we'll get that up and running. And Chris Vecchio would like to always say thank you. Just read it. But once again, Chris, thanks for coming. And, well, things like this happen, but we got it all worked out and everything's fine. So in the meantime, everyone, thank you so much. I hope you enjoyed the Cyber Expo and look forward to seeing your upcoming events here at Cyber University. And like I said, to learn more about any of our speakers, we will be emailing every one of you the recordings so you can catch up on what you missed, or if you'd like to hear anything again and anything else. Thanks again, all the speakers, and from everyone here at Cyber University, thank you so much. Wish you the best of luck and happy trading.